animal spirits are back in the U.S. The outlook is, for the near term at least, is pretty bright. There's a sense of optimism that we haven't seen in a while.
The setup is positive, but at the index level, we don't expect to see huge rises. What we're looking for is broader returns.
Returns have really been driven by a narrow collection of stocks. And in our view, narrow stock leadership is fragile stock leadership.
You have some animal spirits and you have the uncertainty removal and you already have strong growth.
I think you can see equities continue to run in that environment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Grinding toward a key read on U.S. inflation with market euphoria taking a coffee break. Yesterday, stocks absolutely plummeted, pulled back the most in more than 3 weeks, an entire 0.6% as yields rose. Jonathan Ferro is off this week on a much-deserved break. Joining Anne-Marie and myself for this hour is Tchir, head of macro strategy at Academy Securities, who's going to tell us whether this is the moment, this is the pivot point that we all have been waiting for in terms of some sort of retrenchment or just simply people taking a break amid a lot of uncertainty.
You know, it's hard to get a big pullback often in December, right? The seasonality's there. Everyone kind of gets a little bit lazy. It tends to be a pretty trend-following month, but there is risk there. And what I've been warning clients over the last month is I felt early on we were calm down, Trump's going to be okay. And now everyone's got to such a consensus that everything's going to be smooth with Trump. He likes chaos. He's going to reset some of these negotiating points. I expect chaos, and I expect a lot more friction with China as well.
So, Anne-Marie, is this sort of a pivot point? Do you think that we can read something into the fact that we didn't see a 58th record high yesterday, that we saw some sort of retrenchment amid a whole host of geopolitical turmoil?
Well, I think the market is finally waking up to some of the reality that Peter's talking about, that this isn't going to constantly be smooth sailing with an incoming Trump administration. He's already starting to have these conversations about renegotiating trade deals with the likes of Canada, with Mexico, and obviously, of course, what is going on with China. But what's happening with China right now is happening under the Biden administration, which is basically a tit for tat when it comes to the tech industry. Yesterday, going after NVIDIA with this probe in response to an export control from the Biden administration. We're already in this tit for tat. I think the market's waking up to the fact that, you know what, we're going to get a lot more of that next year.
All right, waking up with a 0.6% decline that absolutely changes and shakes all of our expectations. It also came in tandem with an increase in benchmark yields. Some of this could arguably, and you can pick whatever narrative you want and probably find some buyers of the idea. Some of it might have come on the fact that we got a New York Fed November survey of consumer expectations that showed that the share of people saying they expect to be better financially in the next coming year reached the highest level going back to February of 2020, before the pandemic. Peter, how much is this people reassessing how sticky inflation might be, really renewing emphasis on what we might get tomorrow?
You know, I think part of this is I always look at the University of Michigan, and they do break it down by Republican and Democrat, and you've seen a big spike in what Republicans are thinking. So I think some of this is just market psychology. It takes a while for people who maybe lost to say, oh, things might be worse, and everyone who voted, it's like, oh, this is all going to be better. So I think some of these are very sentiment-driven. You know, it does tend to follow the stock market. One thing that's interesting, for all the hype, the S&P 500 is only up less than 1% in the past 30 days. So you would think, if I close my eyes, oh, what's the S&P 500 done in the last 30 days? Oh, it's got to be up 5 or 6%. Not even 1%. So I think that chance of a pullback's real, and it could be coming.
Well, on top of that report talking about higher inflation, that concern, the respondents are also talking about the fact that they feel like there's also going to be a stronger and better economy. But to your point on the politics, this is what John Authers leads with today. Inflation switcheroo rings out the election year. In America, how your party is doing is how you expect the economy to perform. Republicans and Democrats are trading places.
Either way, the market right now is firming up after its terrible fall yesterday of negative 0.6%. You're seeing a bit of firming up across the board, actually outperformance from the NASDAQ. S&P futures basically flat, range bound, but at least not negative, at least not right now. You're seeing some dollar strength, euro falling just about 0.25%, 105.25. Yields again inflecting upwards. Watch this space, 4.2% ahead of a key set of auctions amid a real vacuum of other data ahead of tomorrow's CPI. We get $58 billion of three-year notes being auctioned off today at 1 p.m. And crude prices taking a breather as maybe people take a look at the turmoil with Syria's upheaval and say, maybe it's contained. Coming up, Bob Dahl of Crossmark as the equity rally stalls. Ellen Wald of the Atlantic Council to shed some light on that turmoil in the Middle East and what its implications are for oil. And Cayla Seder of State Street expecting an inline November CPI print. We begin this hour with stocks on hold as traders await U.S. CPI data out tomorrow. Bob Dole of Crossmark is cautious heading into the new year, saying risk asset returns are likely to be lower in 2025 after very strong returns in 2024. U.S. equities are increasingly vulnerable to corrections, given elevated valuations and earnings expectations. Bob, I'm so pleased to say, joins us now. Bob, do you think that yesterday was indicative of some of the perilousness, if you can say that, of such high valuations at a time of great uncertainty?
Absolutely, Lisa. These valuations are up there. When I look at my screen and I see, 25 times trailing and 23 forward, I say, I guess the world's perfect. And it would have to be to justify those valuations. And you've all just discussed the world isn't exactly perfect. Expectations are high for the economy. Expectations are high for what the Trump administration can do. And those good news items must come in to sustain these levels.
That said, you're not exactly a raging bear. I mean, I was looking and you still expect stocks to outperform bonds. You still see gains incoming. So how do you nuance a message of caution without necessarily pulling back in any capacity at a time where other people are saying we're just beginning some sort of AI revolution in U.S. equity markets?
Yeah, so I wouldn't go to 100% cash, but if I've made a lot of money and I'm fully invested and was tempted to take a little money off the table, I think that's okay. I'm fully invested. I've just been moving a little bit more toward neutral. For example, my biggest overweight, thankfully, has been financials. I'm trimming them. My biggest underweight, thankfully, has been healthcare. I'm doing some bottom fishing there, just moving a little more neutral, uncertain about where we head in the new year. Is the Trump administration going to pound the table on cost cutting and tax cuts, or is it going to be more about deportation and tariffs? They're going to give very different answers to the stock market.
Well, Bob, you know that politics are ordinarily a second concern for markets, but they're likely to inject volatility over the course of the coming year. Do you actually move politics to being the first order of business when it comes to the concern for markets in 2025?
Well, only its effect on the economy. The economy and earnings always come first, in my view, but politics, particularly in this environment, have a more than normal impact on those profits.
So when it comes to things like pulling back, you say, on financials, a lot of analysts that have been coming on our program say that actually they are overweight because they're looking at the potential M&A activity, looking at the deregulation that Trump might usher in, given the fact that he did so in Trump 1.0 and he keeps talking about it. So why at this moment would you pull back on something as specific as financials?
So it's still my largest overweight. So I still love the stocks, but I don't want to be a pig. So I'm taking some money off the table, recognizing the valuations have moved up some, and trees don't necessarily go to the sky or go there in a straight line, as it were. So just taking a little money off the table. If I'm not overweight financials, I would get there.
Given your concern about the U.S. economy and valuations, are you finding opportunities either in stocks that focus more globally or in global stocks, or are you kind of very focused just on the U.S. here?
My mandate is all U.S., but there are some interesting things overseas, notwithstanding difficult environment that we see for earnings over there. I would say back to core portfolio, you want to focus on companies with high earnings predictability, Peter, in my view, high earnings persistence, strong free cash flow. Dividend stocks, dividend growth stocks, I think will do even better next year.
Great. So you're going to focus on the dividend sector for next year?
Dividend growth, yes.
That's awesome. Any other kind of outliers that you have out there that maybe aren't top of mind for everyone that you think could be a really interesting opportunity?
Yeah, so I come back to I'll call it quality, although it's not exactly quality, that earnings persistence and the free cash flow. Those stocks have done just fine on the way up in this market. And I think when we get the inevitable pullback, I think those stocks will go down less than the market, showing some relative outperformance.
I'm wondering if you see any signal from what we got from Oracle yesterday. Oracle had really high expectations. Shares had been flying high. They came out basically in line. I mean, I was looking through the numbers, looking for some kind of catastrophe to really justify the fact that their shares were down more than 8%. Couldn't really find it, but it really highlighted those high valuations. How vulnerable are some of these companies, particularly in the tech space, to disappointments when it comes to earnings?
Great point. I think you read it well. That is to say, the earnings were okay. They weren't great, but they were okay. And then you see the stock doing what it did. And you say, what am I missing? Its expectations are just very high in too many places, and I repeat, at a multiple in the low 20s, things better nearly perfect. And Oracle's earnings were not perfect. They were just okay.
I'm looking right now. We just got NFIB small business optimism. And, some of these peripheral reads shed some light on how much the mood has changed. And you can make the argument maybe this is just because of the election and some sort of optimism in terms of regulatory pullback. Nonetheless, you saw a surge to the highest level going back to 2021. You saw the biggest jump in this optimism going back to 1980 at a time where you've seen surprise after surprise to the upside. I just wonder how much of a risk there is that we are underestimating how much strength there is in the economy and what that means for inflation, on yields, and the Fed's path ahead.
Lisa, I think you nailed it there with that set of questions. Look, stocks have moved up a lot to discount that good news that supposedly is coming. And that's why you see sentiment on the stock market and the Conference Board percentage of Americans who think stocks are going to be higher 12 months from now, all-time high. That's generally not a time to pound the table. And you may make another good point, inflation. Inflation is not going to 2% as the Fed wants it, in my judgment, without a recession. In fact, it's stubborn. It's likely to move up a little bit more. You talked earlier on about the 3 handle for the CPI. That's nowhere close to 2, if you will.
Yeah, and this is really a reason why maybe the bond market holds the keys to just how much legroom this market has. Bob Dole of Crossmark, thank you so much, as always, for being with us. We really appreciate it. A fascinating moment as we await for CPI tomorrow. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. French President Emmanuel Macron is bringing together a broad group of political parties as the search for a new prime minister continues. According to Macron's office, he will meet today with all political parties who have indicated they are willing to compromise and form a government. Macron vowed to name a successor after the ouster of Michel Barnier's government last week. The country is still looking to pass a stopgap spending bill, allowing operations to continue without a full budget for 2025. Meanwhile, Brazilian President Lula da Silva is in intensive care in a hospital in Sao Paulo after undergoing emergency surgery, according to an official statement from the hospital. The hospital said the craniotomy was uneventful and Lula, who is 79 years old, is being monitored. Lula felt headaches late Monday evening and a brain scan showed intracranial hemorrhage resulting from an accident he suffered at home back in October. And coffee futures hitting another record high in New York, surpassing levels not seen since 1972. Crop setbacks and droughts in Brazil and Vietnam have fueled coffee's surge of over 80% this year. The rally risks further raising costs for roasters and cafes, which have passed on costs to consumers. Other soft commodities have also risen sharply this year, including cocoa and orange juice. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. So are we looking at a mochaccino that's going to cost $25 now at Starbucks?
I know, honestly, it's about $5, $6, and how much more can it go up? But all of this really years in the making with these disappointing crops, especially in Brazil, but it's getting more expensive.
Honestly, a cup of coffee, that's so frustrating. Up next, something that is vastly more serious, Syria's uncertain future.
It is not a group I am quick to trust. And unfortunately, our history has proven that when Islamist militias rise to power, as things unfold, usually their true side comes out. And they're going to have to really try and impose control if they want to seize that control in Syria.
That's coming up next. But first, we take you to Bloomberg's Women, Money and Power event in London, where Francine Lacroix is sitting down with Banco Santander Executive Chair Ana Botín.
They say it's been designed in a way that incentivizes anybody, whether American or non-American, to invest, and if you do well, then you get some benefits. And so if you look at what our customers are doing, they're investing more in the United States than in Europe. So that should tell us something, it's the carrot and the stick, right? In Europe, we believe in the stick. US believes more the carrot and the way they designed that. So yes, I do think that investment right now will, as it is now, will continue to favor the United States. But again, we have identified the issue and we just need to act, right? And I do think, as I said, that this competition with the US is one of the things that might make us move.
Is Europe overbanked? Do we need cross-border consolidation?
Well, if you as a company are in a market that doesn't grow too much and you're already sort of the biggest or one of the biggest in your country, the only way to grow is actually to do in-market consolidation. That's what we're seeing right now. Cross-border consolidation right now in Europe is very hard. The numbers just don't work, right? And we saw that in the crisis, 15 years ago, right? If you have a euro, but when there's a crisis, the euro becomes the euro in Germany and the euro in Italy, you know what? It doesn't work. And there's many other things that we need to fix. So I do think for now, things have to change a lot before you see cross-border consolidation, but you will continue to see activity in market because there is, the space for growth is very limited given the geographies that a lot of the European banks are operating in and the markets. The tendency will be to get scale, to get profitability and growth.
But will we ever see a proper banking union in Europe? And is that something that should be a goal as, again, Europe faces many challenges?
So banking union requires that, first, it's hard to have further consolidation without some kind of fiscal alignment.
Right now, we're looking at markets that basically are range-bound after the biggest sell-off in more than 3 weeks, which sounds dramatic. But when you actually look at the pullback, it was negative 0.61%. Right now, you're seeing just a little bit of green as S&P futures try to claw up to a 0.1% gain. Under surveillance this morning, one of the main focuses, Syria's uncertain future.
It is not a group I am quick to trust. And unfortunately, our history has proven that when Islamist militias rise to power, you saw it with Osama bin Laden, you saw it decades later with the Taliban. They promise all these things because they are excited at the liberation and they're excited to promise this to the population and that taste of power. But as things unfold, usually their true side comes out. And they're going to have to really try and impose control if they want to seize that control in Syria.
Here's the latest. The rebel group that toppled the Assad's family's rule in Syria will reportedly form a transitional government to prevent chaos. It will be led by Mohammed al-Bashir, the head of the quasi-government created by the Islamist group that took the capital. Bloomberg's Mark Champion joins us now. Mark, there has been a real pivot in terms of the rhetoric from this group, which had been identified as a terrorist organization by a number of different countries around the world, basically saying we want to create institutions. How much do people really believe them?
I think the short answer is that whatever their skepticism, which I think will be justified and deep, there's not much choice but to hope that they mean what they say. They are the only option in town. They now own Damascus. They are taking control. So far, they have done everything that you would want them to do. So you have them saying, we're not going to tear down the institutions, we're not going to drag civil servants out into the street and kill them. They've ordered their soldiers to leave them alone, not to touch the institutions and not to touch the people in them. And so, including someone like Bashir, the new prime minister, it's not so long ago that he was part of the Syrian government. Or the Syrian administration, not the government. I think you have to hope that, these guys will have learned some of the lessons that perhaps also the West has learned over the last, 10, 20 years, and that, certainly Turkey has been grooming them up in the northern areas of, in Idlib, which is close to the Turkish border. The Turks have been supporting them. They had troops there. And you have seen them kind of build a government in exile, an administration in exile there, it's got good, bad, and ugly about it, but it is not, quite what you might expect from a group that was Al-Qaeda, basically.
Well, hope is not a strategy, which is a reason why you see both Israel and the U.S. bombing different sites, trying to wipe out certain military provisions by the Assad government. How much is that disrupting some of the attempt to create a government? How is that being treated by other allies in the region, like Saudi Arabia or UAE?
Yeah, so far I don't think there's any sign that it is, disrupting what would otherwise be happening. The U.S. and Israel in particular are both basically, they see an opportunity, a moment in which to make some facts on the ground in order to secure their positions going forward. given that they don't know how all this is going to turn out, and that, certainly from the point of view of Israel, you have someone in charge at HTS. First of all, he is an Islamist. He hasn't given up any indication that he's giving up Islamism, and that there's a core tenet which is anti-Israel. And a second, thing one has to recognize is that the key is in his nom de guerre, which is Golani. And so his family is from the Golan Heights, which Israel occupies and Syria considers its own. So I think the future, it bears, considerable uncertainty and friction, and that is what both Israel and the U.S. are trying to get ahead of at the moment.
Mark, different groups and different states, but how much does HTS's fresh rhetoric sound like the Taliban in 2021 coming in and saying we are not the same people with the same rhetoric and ideals we held 20 years ago?
Yeah, there's a lot of similarities. The only thing I would say is that, Syria is not Afghanistan. They're quite different places. They have similar. It's more. If you want to look at similarities, it's a better model is Lebanon in terms of the breakdown of demography and ethnic groups and so on. So it will be very difficult for HTS to hold the country together. That will be their big challenge. The other thing that I think one has to recognize is that they know they need money. One of the reasons why Assad, nobody fought for Assad, is that he had about 7 years after the fighting really died down in which to start, rebuilding some kind of economy, creating jobs, etc. He did nothing. He achieved nothing. He had no money. His sponsors, Russia and Iran, weren't willing to part with the sums of money that were needed. So you can imagine the discussions between Golani and the Turks. You were basically saying, look, if this is going to work for you guys, then you're going to need money. You're going to need us, the Turks, and we'll be your liaison. So we'll see how that plays out. I'm frankly, personally, quite skeptical that this will go in any sense smoothly. But it is not quite the same as Afghanistan.
Mark Champion of Bloomberg Opinion, thank you so much for being with us. Peter Tchir of Academy Securities, who sits alongside a whole host of generals. How are you viewing this from an investing and from a former general stance when you talk about it at your company?
So I think, one, we're revisiting what's going to happen with Russia vis-a-vis Ukraine, right? All of a sudden, Russia looks a little bit weak, right? Prior times, they'd put tanks in, Aleppo, they've done things to support him. They look a bit weak. Does that mean we wind up pressing harder on Putin? And what's happening with Iran? Again, one of their proxies, again, is failing. Iran has done nothing but look weak. I know Trump has talked about trying to get some peace. So I think we're going to see a really big push on this weakness that may turn out to be good for both situations.
When it comes to Iran, they need Syria for their logistics, for their training, for their transport into their proxies. But at the same time, they could double down on what they want to do in terms of enrichment of nuclear and building a bomb. What kind of Iran do you think we get out of this?
That's been the big question for a while, right? We kind of view that Iran has shown themselves to be a little bit impotent, right? They were not able to support their proxies. Their attacks on Israel have not gone well. Israel showed that they could basically attack Iran with impunity. So they've got to be rethinking their situation. I think they're feeling a little bit of pressure. And the other thing we do think, and I think the Biden administration started a little bit just again recently, is enforcing the sanctions that are actually in place, both with Russia and Iran. We've let them, distribute oil across the globe to fund themselves. I think you're going to see that constraint. So I think there's going to be a lot of pressure militarily and economically to put on those countries.
It might be a tipping point, some sort of watershed moment for the Middle East. Right now, you're seeing oil prices down about 0.6%, so we're not necessarily seeing massive moves there, which really is a key question. At what point does this create a threat to oil supplies? Coming up, Ellen Wald of the Atlantic Council on the outlook for oil amid what you've been hearing about, that growing unrest in the Middle East. Right now, futures just turning upward, inflecting upward after the biggest down day in more than 3 weeks of 0.6% decline. This is Bloomberg Surveillance. Can't keep keep a good market down. That seems to be the theme as we look at stocks trying to climb to positive territory ahead of the open after yesterday's down day, the first and the biggest going back more than 3 weeks. Right now, NASDAQ really climbing more than the S&P, but Russell 2000 once again the outperformer as people look forward to the idea of lower regulation as well as potentially some sort of ongoing U.S. economic exceptionalism, up about 15 basis points. If you take a look, the real question here is how much does that really hinge on the bond market? You are seeing yields just climbing a little bit, and this really is underscored by the NFIB Small Business Optimism Index that came out this morning. And AMH, there's this feeling that small businesses and across the board, there's this incredible optimism. At what point can that come without some sort of inflationary impulse? How do we understand this sort of renewed bout of optimism?
Well, it's a good question because when you look at the survey, the chief economist says the election results signal a major shift in economic policy, leading to a surge in optimism among small business owners, going on to say they're talking about tax and regulation policies that favor strong economic growth, as well as relief from inflationary pressures. Well, what about tariffs? What if the input costs for all your small businesses are actually going to go up? That's a problem that the market just continues to ignore. They're pricing in all the good stuff from Trump 2.0, and they're starting to ignore continuously the bad stuff.
Right. Everyone's now kind of assuming these negotiations are going to go smooth and we're going to get this big win. And I like that view when no one thought that was the case. Now that everyone's shifted this way, I think Trump looks at this and like, ooh, I might as well up the ante and push. And one of our generals was very involved with the first round of tariff negotiations and believes that Trump feels he got kind of screwed by Xi. Xi said he was going to buy a lot of our ag products. Xi did not come and follow through, so he's much more aware of that. So I think these are going to be fairly contentious, and he's going to look for a lot of guarantees and things that Xi might not be prepared to do on day one. So I think you're going to get some negative noise and chaos around this coming up.
Why talk about the negativity, though, when people are feeling so positive? A real question as we head into Friday. We get an ECB rate decision at a time where the euro has really fallen out of bed versus the dollar. You see that move ongoing today, down about 0.2%. You could see 105.33. A real question, will the ECB not necessarily cut rates, but will they cut by 50 basis points, which a lot of people are saying could be necessary? They need to. Question is, what would the reaction be like in markets?
Well, the underlying economies have been saying, yes, we could use this right now. And you have to think it's getting even more worrisome for Europe when the fact that the core of Europe, the two engines of growth in Europe and those economies are dealing with absolute political paralysis that we're not exactly sure how it's going to shake out. And it's the periphery that's doing well. So a lot of people are saying maybe the ECB does do it and goes 50.
Yeah, and we've been looking at this. So from a NATO standpoint, right, Europe's been cohesive. We're working well. We're seeing this economic separation, right? We are clearly going to go after China. I don't think Europe's in any shape to really fight with China the way maybe they should be. That leaves the German economy very vulnerable. So I think there's kind of this fracturing or disappearance within Europe and with our relationship there. So I think it's going to be a drag on the global economy next year. And that, again, is not getting factored at all into U.S. stock prices. It's clearly affecting, European stock prices, but nothing in the U.S. so far.
So basically, you're saying the disappointments are more likely in the U.S. than in Europe at a time where a loss has been priced in.
Yeah, so much has already been priced in, though, again, I think they're going to start dragging things down. I do not think the ECB will do 50. I think they probably should. It's going to be kind of contra to what they look at. But again, it's really hard analyzing Europe, where Germany has been this juggernaut. And you always looked at Germany as pulling everything together, being very, we have a plan, we know what we should do. Germany no longer does, and that's a bit scary, I think.
Meanwhile, a lot of us focusing on what's going on outside of markets. Under surveillance this morning, something has taken a lot of oxygen out of the room across Wall Street and Main Street. A 26-year-old has been charged with the murder of insurance executive Brian Thompson. Luigi Mangione is an Ivy League graduate who worked as a data engineer at TrueCar. He was arrested in Pennsylvania yesterday with a homemade gun and a manifesto, which a person familiar with the matter described as anti-capitalist and critical of healthcare companies' profit motives. I have to say, I was glued and riveted to this, as I'm sure everybody has been. A real question of what went wrong for somebody who seemed to be born into a life of privilege, who seemed to be highly educated, and then perpetuated a crime that really undermines the law and order of a society that really depends on it.
Well, I think you need to look at this handwritten manifesto that talks about he's apologizing apologizes, he says, for any strife and trauma, but it had to be done. And the New York Police Department is saying this is the motivation and speaks to the mindset of this individual. But I was struck by what Governor Shapiro came out yesterday and said, because they apprehended him and arrested this individual in Pennsylvania. And this is what Shapiro had to say, the governor of Pennsylvania, at this briefing. In America, we do not kill people in cold blood to resolve policy differences or express a viewpoint. All of this because the triggering online rage directed at the insurance company, not the potential murderer.
Yeah, really raising a question about how do you go about affecting change? You can be critical of a particular area, but you can't go and just undermine the question of law and order. I have to say, Peter, it raises a question about security details among executives and what kind of increased single-man risk really gets raised at some of the companies that have been targeted for a lot of rage.
Yeah, I think everyone's going to have to take a closer look at their personal security. If you're a senior at one of these companies, it's scary that this could happen and seem to happen so easily and seem to take a while to find this person. So, yeah, I think everyone's reviewing that. And it is kind of awful that, again, you get this weird discourse out there that makes no sense, right? Everyone to me should be against crime, against killing anyone. And you get this weird messaging out there that's kind of truly just bizarre and almost sad and does scare me. What does that tell people?
Yeah, we'll keep you up to date and when we get further updates as we do. Meanwhile, TSMC's sales rising 34% in November due to sustained growth from AI demand. The Taiwanese company is the go-to chip maker for Apple and NVIDIA and is seen as a bellwether for the build-out of AI data centers. Shares of TSMC are up about 80% so far this year, as you do see them absolutely the juggernaut of the AI industry.
Pretty incredible, given the fact that we've seen some halt in supplies to Chinese AI chip designers. We've also seen Samsung, Intel struggle when it comes to manufacturing some of those contracts. But it's these data centers, big tech firms, Amazon, Microsoft, that is what is really the insatiable demand that they have that is really lifting up TSMC, which feels like at this point, the sky's the limit.
Yeah, which is the reason why people are looking at who the winners are and who might not be benefiting as much. Going back to Oracle yesterday, if they aren't necessarily capitalizing and stealing share away from some of the behemoths. Another story we're watching, Israel launching airstrikes on hundreds of military targets in Syria and sending troops deeper into the country. Israel's army radio describing the attack as one of the biggest strikes in the Air Force's history. This coming after rebel groups toppled Bashar al-Assad's government over the weekend. Peter, how much are you looking at this as some sort of escalation or a broadening out? Or do you just do the generals at Academy view this as just prudent risk management at a time of turmoil?
Yeah, I think it's a very awkward situation, right? I think the good part is Iran looks weak, Russia looks weak. The scary part is what's going to come out of this? What do we do to prevent this escalating? And then, again, we're all watching. And so far, I think we kind of view that Iran is basically the enemy of the entire Mideast, right? And that's why Israel really hasn't lost support of the Saudis and these other countries during this whole conflict. So we'll see where they come out. But I think it's going to reinforce that Iran and these bad people are actually the enemy of the Saudis and the rest of the Middle East who want to move on. They want to westernize their economy. Saudi Arabia wants to become the data center capital of the world. They need to get past this, and this is not going to help. But I think there's going to be pretty strong support to make sure that nothing bad emerges out of Syria.
Talking about Saudi Arabia and turning to commodities, oil paring back recent gains following the fall of Syrian President Bashar al-Assad's and ahead of OPEC's year-end conference. Ellen Wald of the Atlantic Council, also author of Saudi Inc., writing, the oil market does not seem fazed by these events. Prices climbed 1% in trading on Monday, and the market is still more concerned about the tepid economic growth outlook and supply growth forecasts for 2025 that could put the market into oversupply. Ellen joins us now. And Ellen, I want to start with your experience covering the royal family in Saudi Arabia and your intensive knowledge of the country that a lot of people are saying has to be the main operator in this event. What do you think their mindset is, seeing the fall of Syria, and what their role is in trying to impose some sort of new order in a key stronghold in the Middle East?
That's a great question. And I think that Saudi intervention and Saudi involvement at this point could really play a key role in the future of what Syria looks like, and also whether this instability spreads to other areas of the region. I think that the Saudis want stability. Bashar al-Assad was a very stabilizing force until he wasn't. And now that he's gone, the potential for a real failed state and potential for more insurgencies to take root is very, very high. And the Saudis want to prevent that. They want a stable rule over all of Syria. And so they really have a potential right now to both influence the development of whatever new government or power comes in, but also to influence how well that regime is able to hold on to power. And I think that oil and fuel is very, very critical at this juncture, because even though Syria has the oil and gas supplies that it needs to supply its own demand, it's not going to be able to get them up and running in time to stabilize their hold on power. And so essentially Syria's been dependent on Iranian fuel and Russia and these other kind of pariah nations for a very long time. And Iran is clearly not interested in supplying that fuel. We saw this very dramatic tanker turnaround right in the middle as soon as the Assad regime fell. And so if Saudi Arabia and other Gulf countries with kind of stable monarchies can step in and help provide them with the electricity, the fuel and aid, to start to rebuild and start to consolidate their hold on power, then they could prove to be a very stabilizing force in Syria and in the rebuilding of whatever is to come. And so I do think there is an important opportunity for the Saudis, along with others in the Gulf, to really influence the future trajectory of Syria.
Well, who do you think is best positioned to really fill that void? Saudi Arabia, Iraq, Kuwait, the Emiratis?
It's difficult because the political and religious makeup of Syria is very different from the Gulf, but I think that at this point, those sectarian differences matter a bit less than really who comes through with the aid and with the fuel and the money and the medical supplies and the food that they're going to need. And I do think that the Saudis could take a leadership role in kind of a coalition effort to supply these things and really to do, to become that stabilizing force.
Yeah, and pulling this back a little bit more domestically, how successful do you think, drill baby drill will be? Is that something that's going to be effective, really ramping up our production? And do you have any thoughts on what we should be trying to do with the refining industry, which has really kind of been stagnant in this country, I think, for years?
Yeah, I think I kind of wish the refrain was actually refine, baby, refine instead of drill, baby, drill, because at this point, production in the U.S. is at its highest. I mean, we're at like 13.5 million barrels a day. We're the largest producer in the world right now. How much more do we really need to produce? How much more do we really need to throw into this, market that's kind of verging on oversupply? But what we really could do, and what I think would really help both the American people and our trading partners abroad, would be to really take a look at our refining industry, to put in some new refineries. We've seen refineries closing and shifting to biofuels, which aren't really all that profitable or useful. We need to really maybe have some new refineries, and we could really, I think, keep gasoline prices down and fuel costs down that way, as opposed to just producing more oil and shipping it abroad, because we can only utilize so much of that in the U.S. We can also, if we have more gasoline and other fuels, then we can ship that and export that equally. So I do think that really we should change that refrain to refine, baby, refine. It just doesn't roll off the tongue quite as nicely.
We don't have a state oil company the way these Gulf countries do. And we just heard from Chevron, I believe it was last week, that said, actually, we care about free cash flow more than we care about production growth. And they're actually starting to pull back in the Permian. So what is the U.S. in total spare capacity?
That's a great question. I don't think that we can really talk about the U.S. in terms of spare capacity because, like you said, there's no state-run oil company. Every oil company decides for themselves what's in their best interest. For a very long time, for a long time in kind of the height of the fracking period, we had this kind of ethos where everyone had to produce, even if they weren't even, making up their costs, simply because they had to keep ahead of payroll. And so you could be sure that the push and the drive was to increase production. Now that's not the case. Now that you've got big companies like Chevron, Exxon, and really consolidating, and there's a lot of consolidation in the Permian, Permian, you're seeing less of this push and more of a sense of, okay, what's a healthy growth rate? What's healthy for the company? And so I don't think we're going to necessarily see much more growth or a significant amount of growth in terms of oil production. And I do think the focus should really be on what do we do with this oil and how are we best using it and how can companies maximize, their profits with the oil that they're already drilling.
Ellen Wald of the Atlantic Council, thank you so much for your time and for your insights, particularly on Saudi Arabia. The focus in Washington, D.C. might be on how to maximize profitability in a sustainable oil backdrop. Right now, it's on a number of other things as well. Let's get you an update on that and other stories this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Donald Trump's defense nominee, Pete Hegseth, says the president-elect has told him to keep fighting for Senate confirmation. The former Fox News host and military veteran appeared on Fox's Sean Hannity last night after meeting with a key Senate Republican, Joni Ernst. Hegseth has been looking to bolster his Senate support amid allegations of sexual misconduct, alcohol abuse, and workplace mismanagement. After their meeting yesterday, Ernst said she'll support Hegseth through this process and that she looks forward to a fair confirmation hearing. Meanwhile, Boeing restarted production of its workhorse 737 MAX model last week. Reuters reporting production resumed last Friday. The move comes a month after a strike by 33,000 factory workers shuttered the plane maker's commercial manufacturing. Boeing shares are off by nearly 40% this year. And Michelin announced its New York 2024 stars this week. A modern Korean restaurant in Tribeca, Jungsik, joined the 3-star club. It's the first Korean restaurant in the U.S. to get the top ranking. Daniel Boulud's restaurant, Daniel, demoted to 2 stars. That's down from 3. A total of 74 restaurants in the state getting a star. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I imagine that their reservations just shot through the roof in just one night.
There's one this week, Thursday, for 2 people at 9 p.m. Too bad it's past my bedtime.
Glad that's where the focus is. Up next, growing rate cut optimism.
The fact that the unemployment rate went up means that the Fed will be comfortable cutting by 25 basis points, means that the market will increase the probability of this happening.
That's coming up next. This is Bloomberg Surveillance. Futures just inching higher as the session grows older now pretty much across the board. S&P and NASDAQ futures up almost 0.1%, more than 0.1% if you look at the NASDAQ. And you can see part of this is coming without cooperation from yields, which raises a question. How much conviction do people have about the Fed becoming less restrictive? Under surveillance this morning, growing rate cut optimism.
The challenge for the market and for policy would have been a consistently strong report. This is a somewhat strong report, but not consistently strong. The fact that the unemployment rate went up means that the Fed will be comfortable cutting by 25 basis points, means that the market will increase the probability of this happening.
Which certainly is what's going on right now, with an 86% chance of a rate cut priced in for next week's meeting. Here's the latest. Traders bracing for a busy end to the year. Key inflation data out tomorrow and a Fed rate decision next week. Cayla Seder of State Street Global are writing, current inflation trends are not consistent with the Fed's summary of economic projections. Our daily measurement of online inflation suggests November inflation should come in line with consensus 0.3% headline and core. Cayla joins us now. Cayla, thank you so much for being here.
Thank you.
How vulnerable is this market to a wake-up call, even if there is just a medium-sized surprise to the up when it comes to inflation?
I think when it comes to next week, the market looks very convinced that a cut is coming. This concern about inflation trending higher and being too sticky, I think is probably going to be more of a 2025 story. So when we think about the reaction last winter, we saw consistent spot 4 prints. And so when we see this spot 3 print likelihood for this week, we think, okay, maybe the Fed could look through that and that But for how long is the question.
Well,
right?
and what's the response in markets, right? So it's one thing for the Fed to look past it, to cut rates. It's another thing for the bond vigilantes to say, oh, not so quickly. And then all of a sudden you see a sell-off in the long end. How much is that the telltale sign? Particularly tomorrow, given the fact that we have essentially a Fed rate cut baked into market expectations.
Yeah, I do think the long end could be susceptible here. And that's actually something that we're looking at this week with auctions, right? And seeing what, I know, auctions.
Thank you.
Seeing what demand is like there. One thing we are looking towards next year is an increased likelihood for a bear steepening. And there are consequences of that in terms of markets, and that really feeds into a lot of our equity views as well. And so that's something, maybe it won't be so much a story for next week, but certainly could be a story for 2025.
And with the unemployment rate ticking higher, even actually as close to 4.3 as it is to 4.2 when you look out the decimals, do you think the bias is starting to shift at the Fed towards inflation?
I think that's right. Especially when we look back at September, right, and end of the summer, there's a lot of concern around the labor market. But really, I think when we look at some of the inflation trends, there is underlying stickiness there, and it's consistent, right? We've seen consistent spot 3 prints. And so when we look at the labor market, it is tricky when it's a balanced look, because that means that if you see moderation, you're worried that balance is going to tip into weakness. But right now, we don't see that yet. And so really, I think that puts more of the rhetoric on the inflation part of the story.
What's the emphasis on inflation right now going into 2025? Is it the policies that we may get, or is it just what is going on in the underlying economy?
I think it's helpful to look at where the progress on inflation has been made, and then will policy really enable that progress to continue? Because a lot of the progress on the inflation front has been on the goods side and not as much on the services side. And so you have to ask, is this A, will the goods disinflation continue, but B, will the services inflation really crack? And also housing. We really haven't seen much progress on the housing front just yet.
Are you concerned at all about the deficit, how that's going to play out next year?
Yeah, I think that's definitely going to be a big story next year. And especially when we think about, okay, how is Treasury going to fund the deficit? Is there going to be this shift away from bills and more into notes? And I think that could actually shift some of, you have implications for asset allocation. Because when we look at our real money data, what we see is very underweight fixed income, above average exposure to equities, and a little above average exposure to cash. And so if we see this increase in issuance, especially on the note side, that could increase demand for fixed income at the expense of cash.
That makes sense to me. So you would see a yield curve that's steepening then?
Yeah.
And that's going to put some pressure on equities as money chases that.
Agreed.
That makes sense.
This, to me, has really been the key question. What point does that sort of increase in the yield curve end up torpedoing some of the optimism? Not to be Debbie Downer. Cayla Seder of State Street, thank you so much for being with us. Peter Tchir, you spent the whole hour with us, which we're incredibly grateful. Do you agree with that kind of idea that essentially this is a market that's underpriced for that type of bear steepener?
Yeah, and I think what's gone on is we really pay a lot of attention to positioning. Everyone got so bearish. It seemed kind of insane when we got to 445 on 10s. The positioning's got squeezed us down to 415. I think now we can start going back the other way. Everyone got a little bit ahead of themselves on their bearish sentiment. It kind of was the pain trade to go lower yields. I think we see higher yields now. I think it's relentless. And I do think the Fed is done in this meeting, but they're going to slow down after that, and that's going to cause problems across the yield curve.
Relentless. Go on. To what level are you talking?
So,
you can't just throw things out like that.
So, I think we get back to 450 probably on 10s, maybe as early as January, maybe higher. And I really right now in this liquidity environment, I always think a risk of a 50 bip gap higher is much, much greater than a gap of 50 bips lower. The market's just not well positioned for that. And I keep looking at the liquidity. It just does not seem deep. And that to me tells me that that risk is for a much push to higher yields. And China, I keep watching. I think they're not going to be buying treasuries. That was one of the big supports. They have their own problems to deal with. So I think there's a lot of pressure coming into this new year, and we've become complacent.
Basically, watch the auctions. Peter Tchir of Academy Securities, thank you so much. Coming up in the next hour, don't miss this. Skelly of Morgan Stanley, former State Department spokesperson Morgan Ortagus, Danielle Hale of Realtor.com, and Jill Carey Hall of Bank of America as markets climb out from the stupor of a 0.6% pullback yesterday. This is Bloomberg Surveillance.
looking at the Fed right now, I don't think we can rule anything out.
What can continue on for another year? Fed continues to ease, not at every meeting, but continuing into 26.
Recession risk is elevated. It's certainly elevated, and so I would disagree with Fed officials that it's not elevated.
As we get closer and closer to that 2% target, I think you're going to see the FOMC opinions start to diverge.
We are trying to maintain this soft landing, and the Fed has done an incredible job so far of doing that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back as stocks claw out of their one-day pause of a decline of 0.6%. I keep highlighting this, and Anne-Marie, I know it's sort of
the lamest pullback.
It's the lamest pullback, and yet it was the biggest going back more than 3 weeks, which I think is actually really important as we head towards CPI tomorrow. This has been a market that wants to go higher with 57 record highs, and people just wondering how soon it is until we get a 58, 59, and 60th. At a certain point, we look at this outperformance of Russell 2000 and we say, this is back to the races for the Trump trade at a time. There seems to be this euphoria just hovering over markets that don't want to go down.
Well, they don't. And it's so interesting because yesterday we did have a slight pullback. And a lot of this, people are talking about this fact that maybe they're waking up for the tit for tat, a harbinger of potentially what more could come in 2025 when you have China probing one of the biggest American companies traded, NVIDIA. And then this morning, get some good news, small business confidence. Look at that. Everyone's saying the election results signals a major shift in economic policy. But one thing is for sure, the market continues to price in deregulation, tax cuts. What they've yet to really wake up to is tariffs and how big they're going to be. Are they going to be targeted or are they going to be blanketed?
There's a lot in there, and I think I want to pick up on the point that you rightly raised about U.S. small business optimism. Today is a dated light day ahead of CPI that we get tomorrow, PPI on Thursday, an ECB rate decision on Friday, and then a Fed decision coming up next week. And yet the peripheral data shows the shift in confidence that we've continued to get with small business optimism rising to the highest level going back more than 3 years. A real question here about whether it is assessing a right sequencing of everything that's going to be potentially coming down the pike, and whether it's a head fake or whether this really is something that people can lean into.
Well, people are really leaning into this idea of deregulation. That was part of a hallmark of Trump 1.0, and people say that's going to be a part of Trump 2.0. We also know that he wants to extend TCJA. That is his premier legislation, the tax cuts. But how much more of what's been talked about on the campaign trail will be added? And in reading the tea leaves, whether or not you're listening to what's going on in Mar-a-Lago or also in the Senate, the sequencing right now looks first 100 days is going to be immigration. They're going to get to the tax bill potentially mid-2025. Maybe we don't see that come to fruition the end and beginning of 2026. So if you have immigration policy and you have tariffs in the first 100 days, how negative is that going to be for this market before you get what people are calling the good stuff?
Meanwhile, right now, markets inflecting upward on the good stuff that we've been talking about. You can see across the board stocks, whether it's NASDAQ, whether it's Russell 2000, up just around clawing between 0.1% right off that right now. You're looking at some dollar strength, 105.29, euro losing a little bit ahead of that Thursday ECB rate decision. 10-year yields pushing upward, and I think it's important to note this given the fact that we do have a series of auctions, including 10-year notes, $39 billion of them tomorrow and $22 billion of 30-year notes on Thursday. And oil taking a breather after yesterday's 1% rise on the heels of a whole bunch of turmoil in the Middle East. Coming up this hour, Dan Skelly of Morgan Stanley, who'll be joining us for the entire hour as Jonathan Ferro takes a much-deserved week off. He's taking a look at the rally, which is taking a breather ahead of key data. Former State Department spokesperson Morgan Ortagus as Israel ramps up attacks on Syrian military sites, and Jill Carey Hall of Bank of America Securities, and why mid-caps are better positioned than small in 2025. Let's begin this hour with stocks on hold as investors await CPI data due out tomorrow. The S&P 500 pulling back from a rally, setting it on course for its best year in 5. Dan Skelly of Morgan Stanley looking ahead to next year, writing, "We note widening tail risks, both upside and downside, given the resilience of the economy. Tailwinds from animal spirits and deregulation, as well as, of course, an uncertain Trump policy path. Nevertheless, the earnings per share outlook for 2025 and 2026 remains resilient, which should support positive equity returns." Dan joins us now. I love this. Everyone who comes on explains all the caveats and says, even with all of that, we still are positive, because it's really hard to feel anything but. Are you seeing sort of all of the good stuff being baked into valuations right now with little attention to some of the tail risks that could inflect downward?
Well, first off, Lisa, good morning. It's great to be back with you. And just as Jonathan needed a breather, it feels like this market needs a breather
We all
after
need a
the year
breather.
we've had. But in terms of your question, I think, look, the pattern and the sentiment today is much like it's been the last year, the last 2 years. It feels like we're still trying to climb a wall of worry. 2 years ago it was all about a recession or not. This year it was all about the path of the Fed and the election, and it feels like now people are actually waiting to see, as everyone's talked about on your program, the sequence of policy. And so I think it's going to be tough for markets to scream higher as long as we're still waiting for those outcomes.
At this point, we're looking at Russell 2000 outperforming today, and the initial read yesterday was also trying to outperform. How much is that a misguided policy at a time where, as Anne-Marie pointed out earlier, we've been looking at the prospect of tariffs that will disproportionately affect some of these smaller companies?
You know, it's complicated because on the one hand, tariffs could be challenging. On the other hand, you could have a lot of pro-U.S. domestic growth and confidence. You're talking about consumer confidence, small business confidence a moment ago. And I think the question is, how much does the top line and the growth offset some of the costs? And really, like you also alluded to, Anne-Marie, is it more targeted or is it blanketed? We think it could be more of the targeted style, and it could be a little bit more deliberate. And so as long as you have that sequence of animal spirits and growth before the ultimate cost impact, that could be another factor to think about.
What's your base case, though, when it comes to sequencing? Because tariffs Donald Trump could enact on day one unilaterally without congressional support, while things like immigration reform and tax cuts, he's going to need the House and the Senate.
So we've thought about this a lot as a firm, like everyone else, and we've talked about maybe a flurry of announcements, but even if that's the base case, still taking a lot of time to play out. We don't even think if you have announcements in the first half of the year related to tariffs that the ultimate impact would really even play out in the economy till the second half or even going to 2026. And I guess the last thing I would mention is let's not forget we have a shot clock as it pertains to the midterms in 26. So you can't wait too long to address those tax issues.
Right. They have 2 years, basically, to get it all done in terms of his agenda. You mentioned tariffs and how maybe that means bringing production back home. So do you see them working in parallel, tax cut and tariffs? Because to get potentially that 15% corporate tax rate that Donald Trump has talked about, you'd have to produce in the United States. And maybe tariffs would be the stick to get people back here?
Yeah, it's a really interesting point. We could see them working in parallel. I think a lot of people are playing the horse trading following the tape in terms of the appointments. And so let's also just point out that the appointments related to the potential Trump team have started to circulate a little bit more around the moderates and are a little bit more around broader thinkers versus some of the more extreme thinkers that were maybe mentioned earlier. And so I think to your point, Anne-Marie, that's a good signal in terms of having a little bit more balance in terms of that sequencing.
Well, who do you think is moderate, though, on the tariffs front? Peter Navarro is going to be back in the West Wing.
He is, but he didn't end up getting one of the positions that I think was, rumored to have been talked about earlier. So I think Scott Bessent in particular in Treasury is probably the most widely accepted, reasonable voice and adult in the room in terms of the market perception of policy.
So given all of this, where do you want to be next year in 2025?
So that is the big question, of course. And look, I would say this is, looking backwards, this is one of those rare years where the first half leaders didn't remain the second half leaders. That's been a trend, actually, statistically, that's persisted for a decade. This year, you saw a pretty notable rotation in July and August. We think that rotation in terms of broadening out into value sectors, some more cyclical sectors, can also play out next year. Last, while it's been a mega cap and large cap tech dominated market for well over 18 months, we also see some key themes emerging in mid caps. Again, coming back to more domestically oriented winners, some winners that may have some upside from tax reform, et cetera.
So do you think that big tech is going to keep underperforming, at least based on how it was performing in June and July?
Maybe not as sharp as June or July, because keep in mind, Lisa, you were also just at such a high level. You went parabolic in late May, early June in terms of that tech trade. And positioning, I think, really had to readjust violently. So it's going to be, in our opinion, a more moderate underperformance. But keep in mind, the Fed has finally, via their engraved invitation in September, they've finally let everyone know we are cutting proactively while the economy is still growing really strongly. And that's finally letting people know that leadership can emerge from other sectors, namely value sectors. And the second concept that I'll just highlight quickly, and we can get into it more as the morning persists, but this whole idea of the absence of a negative. Going back a year and a half ago, we talked about it on the show. Tech spending, CapEx related to AI, was almost like a suspension of disbelief from investors. No one cared how many hundreds of billions of dollars were being spent. Now the markets are starting to scrutinize that spending, and they want to see more tangible results of productivity. We just haven't seen that yet.
I'd love your take on what happened yesterday, which was that China came out and announced that it was going to be looking at some sort of anti-monopolistic practices by NVIDIA in China. You saw the shares down about 2%. They're down in the pre-market trading, not very much, 0.6% this morning. How much is this something that you want to be involved with trading versus just ignoring completely outright, given the fact that there's going to be a lot of tit for tat and we're just seeing the beginnings of it?
Such an excellent question. And when you think about it, zooming out, the long-term potential and a lot of the excitement around AI is hard to deny. I think we would all agree on that. And so you look at long-term secular trends in the last 10 years, the last 20 years, 2% of the public market cap in the equity market in the U.S. has created something like $70 trillion of market value. So it's hard to get off these trains longer term. In the near term, however, we've thought about going from being more overweight a year ago to being more of a neutral weight today because of some of the issues you outlined as it pertains to policy and geopolitics, but also just because of that momentum is shifting to other value sectors.
When it comes to these tail risks, essentially, for the likes of NVIDIA and some of these technology companies, do you see the U.S. under Trump 2.0 actually trying to decouple from China?
I think the biggest surprise out there in China markets, which are trading at 11 times earnings right now, juxtaposed against the U.S. trading at 22 times, is that maybe there's some type of window for a deal with China down the road. Let's go back to 2016 and Trump 1.0. There had been a lot of rhetoric along the campaign path against Mexico. And Mexico currencies, Mexico equities performed very badly preceding the Trump election in 2016. Then, of course, we renegotiated some of the trade deals with Mexico later on, and the market actually was a decent performer. So I actually think there's an interesting parallel lining up right now in terms of China. There's so many different ways that you could incorporate a potential deal. It could involve leaning on China to help influence an outcome in Ukraine, which is another desired outcome of Trump. But it could also be an off-ramp for China to get away from some of the economic malaise that they've had. So, the art of the deal could be, at play once again with China.
Dan Skelly of Morgan Stanley will be looking through that throughout the hour. You're going to be sticking with us, which I'm really pleased to say. Right now, let's get you a check on what's going on outside of business news. Here is your Bloomberg Brief with Yahira Hakas. Yahira.
Hi, Lisa. Authorities in New York filed murder charges against a 26-year-old man accused of shooting United Healthcare CEO Brian Thompson last week in Midtown Manhattan. Luigi Mangione was arrested after being spotted at a McDonald's in Altoona, Pennsylvania, where he was found with a ghost gun, fake IDs, and a 3-page manifesto. Mangione remains jailed in Pennsylvania, but authorities say he will eventually be extradited to New York to face charges in connection with Thompson's death. Meanwhile, Donald Trump's daughter-in-law, Lara Trump, is stepping down as co-chair of the RNC. The move comes amid speculation about a possible post in the Senate as Florida Governor Ron DeSantis will look to appoint a successor to Senator Marco Rubio, who has been tapped as the next Secretary of State. Lara Trump telling Fox News she hasn't talked to DeSantis about the possibility, but she would be honored to be asked. And shares of Oracle are falling 7% in the pre-market. The company reported quarterly revenue in line with estimates, but fell short of investors' lofty expectations. Revenue for Oracle's cloud infrastructure business jumped 52%, driven by demand from AI companies. While that's a robust rise, it came in line with what analysts were expecting. Another sore spot was in its revenue guidance for the third quarter, which missed street expectations. Still, Oracle shares are up more than 80% this year. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. It just shows how high the bar has gotten for a lot of these tech companies, given the fact that it wasn't a terrible report at all. And now we're seeing the biggest drop in more than a year.
The bars are getting way too high to clear in these tech companies.
Well, for some of them, and others just seem to hop over them just as the same. Up next, grappling with uncertainty in Syria.
The collapse of the Assad government is an inflection point for the region. It does offer areas of risk, and the United States and Israel are doing everything they can to minimize that risk.
That's coming up next. This is Bloomberg Surveillance. A little bit flat, maybe inflected upward after yesterday's decline, which was the biggest going back more than 3 weeks. It just highlights what euphoria we've seen. You do see yields continuing to inflect higher. Watch this space. 10-year yields up 3 basis points, 4.23% ahead of some key auctions. And of course, CPI data coming out tomorrow. Under surveillance this morning, grappling with uncertainty in Syria.
The collapse of the Assad government is an inflection point for the region. It does offer areas of risk, and the United States and Israel are doing everything they can to minimize that risk. I'm optimistic that there are more opportunities for regional players to improve the Middle East with the collapse of Iran's axis of resistance. At the same time, this requires an international effort to support those players.
Here's the latest. Israel stepping up its attacks on military sites in Syria, sending troops deeper into the country. Syria's power vacuum putting U.S. Middle East foreign policy to the test as senior diplomats rush to the region for ally talks on maintaining stability. Joining us now is former U.S. State Department spokesperson Morgan Ortagus. Morgan, I just want to get your take on what the U.S. will be involved with, how their involvement will really develop over the coming days and weeks.
Well, it's certainly going to be tenuous. I think the biggest focus for the U.S., and you can see this from the bombing over the weekend, is going to be ISIS. That's, of course, the immediate threat to our allies in the region, in the Middle East. We know that we still have these prisoner camps that have tens of thousands of former ISIS members. They now have children in these camps. The Kurds were watching over those camps. So that, of course, is the immediate threat, because there was a physical caliphate of ISIS in Iraq and Syria. President Obama at the end of his term and then President Trump at the beginning of his term really unleashed the U.S. military to make sure to destroy that physical caliphate. So the prisons, watching over ISIS, making sure it does not reconstitute, and importantly, protecting the Kurds, I think are going to be a focal point for the last couple of months of the Biden administration going into the Trump administration as well. It's fascinating, of course, to see Russia and Iran rushing to abandon their military outposts in Syria. You see Russia's trying to get their assets and their people, their military personnel out, as well as Iran. And I think that's really indicative for how Russia and Iran views their partners in the region. As I've always said about Iran, they would like to fight to the last Arab. But to the extent that you have seen them abandon Hezbollah, really abandon Hamas as Israel has gone after them, and now they appear to be abandoning their allies in Syria as Assad has fled. I think if you are an ally or a friend in the Middle East of Russia or Iran, you have to be thinking twice about how good of a partner you have right now.
Who do you think fills that gap then? We were speaking to Ellen Ward earlier just about who fills the gap when it comes to fuel going into Syria, and a lot of that was coming from Iran. What Gulf states could fill that void?
Fantastic question. So you've got a few different things going on right now with Saudi, with UAE, and with Qatar. Per usual, I think you're going to have a healthy sibling competition between those three Gulf Arab states. Qatar probably has the best relationship with HTS, with the Syrian rebels. I think they're the only Gulf state that are in immediate talks. And then, Saudi seems to be the most realistic of the new situation in Syria. The UAE, of course, within the past few weeks was working with the Biden team, with Brett McGurk and others, calling for de-escalation. They had been the ones over the past few years kind of leading the effort to normalize Assad, to try and get him back into the Arab League. They, of course, course, would have argued the civil war going on since 2011, Assad had remained in power. It was time to sort of bring Syria back into the fold. That was the UAE position. That no longer exists. Saudi, I think, is very, they of course have the most access to be able to help on the oil front. And I think they're the most realistic of what the new situation is in Syria. But again, back to Qatar, per usual, they're in the middle of it, they're in the thick of it, and they have the direct talks with the rebels, with HTS.
How concerned do you think some of these Gulf states are about Israel and overnight this incursion 16 miles southwest of Damascus right now?
Yeah, of course, the United States, Israel, we're all very concerned, like I said, about any type of leftover weapons, chemical weapons, of course, that we'll remember the Obama administration had negotiated with Russia that those chemical weapons would be destroyed in Syria. We know, of course, no surprise to anyone, that the Russians cheated, and we believed many of those chemical weapons remained. So, of course, I think there's a scramble by the United States and Israel, not only on ISIS, but on any type of weapons that could get in the hands of the wrong proxy groups, of the wrong groups that might endanger the United States, Israel, or her allies. You know, I think whenever you look at this in pure terms of who's up and who's down in the Middle East, clearly Iran and Russia down. Anytime Iran is down, that strengthens the hand of our Gulf Arab allies. I also think this is a really good day for anybody who participated in the Abraham Accords. You know, after October 7th, especially after Israel's incursion into Gaza, there was a lot of talk about would the Abraham Accords, which in a diplomatic agreement that I was a part of in the Trump administration, there was a lot of discussion of would they hold, would these Arab states be able to stand by Israel? Not only did they hold, which I think is a positive sign, especially from an economic and diplomatic perspective, they held, but to me, they seem stronger than ever than today. I think that there's still a chance, despite everything that's happened in Gaza, that you will see Saudi potentially go into that deal or into a bigger deal, simply because you see Russia and especially Iran weakened. Iran basically has the Houthis left in Yemen. They have the PMF left in Iraq, and of course their own Quds forces that are still significant. But don't forget, whenever Israel returned fire to Iran after Iran hit them for the second time with ballistic missiles, Israel largely destroyed a lot of Iran's missile production capability, a lot of their air defense systems. So Iran itself is in a weakened state, and most of their proxy empire across the region is basically falling apart.
Morgan, what is your confidence level that some further escalation won't persist here? I mean, if you look at the recent history, just in terms of shifting power dynamics in the Middle East, whether it be Afghanistan with the Taliban, whether it be Iraq, I mean, anytime there's a major power that falls out of favor, it's really rare or unlikely that some of those risks don't escalate. So what is your confidence level?
My confidence level that things won't fall apart is pretty low. I think listen, that might be the likely outcome. Certainly in Syria, when you have so many different factions, around the country. And, I asked a Syrian American friend who fled the country whenever he was 9 years old, somebody who had worked with the U.S. military, really sophisticated guy. I said, well, who's in charge now? And he said back to me, great question. So I think even people who've worked intensely on Syrian diplomacy for a long time recognize that this is a massive challenge. I think it's interesting that you bring up Afghanistan and the Taliban. I think it's an even harder challenge than that, because at least when the Taliban took over, we knew all of the heads of the Taliban. We understood who would be leading, whether we agreed with them or not. There's very much a chance. I think Syria could potentially look a lot more like Libya, for example, in the aftermath of their civil war than like Afghanistan, because it was somewhat of an orderly transition in Afghanistan after the Taliban took over. Not something that we wanted, not the group that we wanted, but I think there's definitely more of a chance in Syria for it to look like Libya with warring and fighting factions. In the present tense, over the next couple weeks, we're mostly going to see Russia and Iran scrambling to get their people and their assets out of the region. By the way, huge loss from a naval perspective of that Mediterranean base for Russia. And that will have reverberations for a long time for Russian foreign policy.
Former U.S. State Department spokesperson Morgan Ortagus, thank you so much. Great insights as we try to understand what even to look for with the reordering of the geopolitical powers in that region. Coming up, we're going to shift focus to the real estate sector. Danielle Hale of Realtor.com on the state of the housing market. That coming ahead of CPI, where that's supposed to be a significant component of the increase that we may see tomorrow. This is Bloomberg Surveillance. Two hours till the opening bell, and we look at futures that are inflecting higher after a day of losses yesterday across the board, up 0.2% now on the NASDAQ 100. With the morning movers, here is Manus Cranny. Manus.
Lisa, good morning. $14.1 billion in revenue is just not enough to sate the analyst community or the market for Oracle. Yes, it's having its best year since 1999. It's up 81%, but the guidance was lighter than the market had anticipated. The revenue will rise by 8%. But the cloud business by 24%. And here's the rub. Where does Oracle fit into the grand scheme of cloud services and delivery between Amazon Web Services and Microsoft? They say they've got faster and cheaper cloud services than their competitors, but it's about convincing people to come across. Still, the analyst community say Piper Sandler $210, up from 185, and Citi raised it to 194 from 157. So it's about the initial knee-jerk on the guidance. Let's stay with data analytics and the AI overlay. It's a common theme in this set of results. C3 AI, very comfortable beat, up 29% on the revenue at $94.3 billion. And they're rolling out 15 generative AI focused programs. So this is about making it easier to, if you're a cloud customer of Microsoft, how do you make using that data much easier? And that is essentially what this company does. They're running trials and products with Rolls-Royce, the Navy, and again, this velocity is not in the price according to Piper Sandler. The agreement with Microsoft has a material upside that is not yet priced in this. I'll leave you with a thought on TSMC. This is the ADR. Again, a huge supplier to the world. Talk about dominance. Stock down 1%, dominance and gaining pricing power, but just a little bit lighter on the sales numbers than we anticipated for November. Up 34% in November. The market was looking for a growth of 36%. But they have got pricing power. And if you want to understand dominance and why Intel has a fundamental problem, this company controls nearly 65% of the global foundry business. And therein lies the issue for all the competition out there. Lisa.
Thank you so much, Manus. Great stuff, as always. Dan, what do you make of this? The fact that basically you see Taiwan Semiconductor coming out, 34% gains, looks pretty blockbuster. Oracle coming out, delivering 50% rises, shares down. I mean, how much does this really highlight how high the bar is?
I mean, it's totally what's going on. These trades had worked so well for the last year, the last 2 years, and even more so related to Oracle, the software pivot was very hard and fast. The last 6 weeks, the markets have been saying we're moving on towards the application layer of AI. And that was a theme that people have been thinking about for a year or so. While everyone was playing utilities and powering AI and the infrastructure middle layer, no one had really yet played application. And so I think you just had a lot of people chasing that trade that are getting thrown off by a classic expectations miss.
Which is a real question coming into next year. Meanwhile, under surveillance this morning, a lot of people focusing on this story. Authorities arresting the man they say is responsible for the fatal shooting of United Health CEO Brian Thompson. 26-year-old Luigi Mangione was apprehended in Altoona, Pennsylvania. He faces charges in New York, including murder, criminal possession of a weapon, and possession of a forged document. A real question here, Anne-Marie, of what went wrong as a lot of people look at someone who was born into a life of extreme privilege, went to a prep school where he was a valedictorian, graduated from UPenn, was in the tech space, and something went so wrong.
Yeah, incredibly bright individual that had a bright future. If you look, it's also some of the local reporting from individuals who went back and interviewed his high school teachers. What struck out to me yesterday, though, was what Governor Josh Shapiro said. And I think we should reiterate what he said after they arrested this individual. He came out and talked about the vitriol that we've seen online about the hate against the man who was murdered just a few blocks from where we're sitting here in New York City, saying he has no tolerance, nor should anyone, for one man using an illegal ghost gun to murder someone because he thinks his opinion matters most. And you're really seeing this debate take take on online. And Shapiro called it deeply disturbing.
And look, it's innocent until proven guilty. We don't know. It needs to go through the trials. But there is a real question here about the business implications at a time where this is a very high profile and shocking murder in broad daylight in New York City in an industry that has come under a lot of fire. And there's a real question with United Health reeling from the loss of their colleague, the fact that he was murdered while also trying to stave off some sort of public relations issue. It just raises a question of this type of backlash. And this sounds callous to go there, but the market implications of it at a time when that can really gain steam, Dan, online or elsewhere.
Yeah, so look, I would just say as it pertains to the insurers, I think this was an industry that was always under the radar from a lot of public sentiment, vitriol, et cetera. This is obviously a horrible event. I would also just add that stepping back, the industry as a whole was also trying to get back to normal after a period of massive flux. You had a lot of procedures coming back into play, and the cost spectrum was rising anyway for the insurers. I think there was a lot of hope and sentiment around change with the Republican Senate, and you saw the whole sector re-rate higher on top of that, and now you're kind of back to that pre-election low. So admittedly, the sector looks, at least from a fundamental perspective, putting all of these other questions aside, the sector looks fairly attractive if you think that nothing dramatic is going to change to the cost structure.
At the same time, a lot of focus on Washington, D.C. and some of the deck chairs that are getting rearranged and then arranged again. Pete Hegseth saying President-elect Trump has urged him to keep fighting for his nomination as defense secretary. The veteran and former Fox News host meeting with Iowa Senator Joni Ernst yesterday. He also plans to meet with Senators Lisa Murkowski and Susan Collins this week, trying to salvage his nomination as he really does come under maybe less fire, but still quite a bit.
Right. So he's still going up there on the Hill and he's still taking these meetings, notably with these moderate Republican senators. Joni Ernst for herself, she's also a vet. She's also a survivor of sexual abuse. So this is an individual that her voice really matters. And she hasn't come up against Trump on a lot of his nominees the same way maybe Senator Susan Collins has in the past. Punchbowl calls it the Hegseth vibe shift, this second go. But it doesn't mean it's done yet. It doesn't mean he has the votes. So there is this chess move waiting in the wings. Wall Street Journal talked about it yesterday. I've been reporting on it for weeks, with Governor DeSantis basically signaling to the Trump camp he's willing to step in and take that job. And then the second or third move to that could potentially be Laura Trump, Donald Trump's daughter-in-law, taking that Senate seat that Governor DeSantis would have to appoint, given Marco Rubio, another Florida name, is taking over for Secretary of State.
That is your chessboard of the day, and we will give you an update on the chessboard tomorrow. Boeing restarting production of its 737 MAX model about a month after a strike by 33,000 workers brought its commercial operations to a halt. Reuters reporting that output picked up on Friday. Boeing shares are down nearly 40% this year. A real question here, Dan, about whether we are looking at a buying opportunity where you've got something on the mat and maybe revival, or are we looking at something that absolutely you don't play in whatsoever?
I would just say stay on the sidelines for now. If you love the aerospace theme, which we actually do fundamentally because there's a lot to like about it, you can play the aftermarket space. You can play the parts, the suppliers, the engines. The OEMs definitionally and historically have been difficult over time. Despite having a duopoly, they haven't always had the most consistent returns, and there's so much management change going on at the moment. We would just say play the aerospace theme via some of these other sectors.
I'm sure that a lot of people are not looking to really dive in too quickly, as we see this morning up 1.7%. Turning to the housing market, home buyers are looking for signs of cooling inflation in the November CPI report due tomorrow morning. Shelter inflation continuing to outpace pre-pandemic levels despite high interest rates. Joining us now is Danielle Hale of Realtor.com. Danielle, this has been one of the big mysteries, and thank you for joining us. It seems like everyone has been talking about how high interest rates would eventually cause prices to come down. All you needed was inventory to come back in to really create a market. We're seeing inventory come back in. Why are we not seeing bigger price declines?
Yeah, thanks for having me. I think that's an excellent question. Some of it is the way that most reporters measure market rents. So the way we measure market rents at Realtor.com, we're looking at rents that are on properties that are listed for rent, whereas the CPI looks at the rent for all properties that are lived in by renters. So it's a much bigger set that CPI is looking at. And while market rents shot up during the pandemic, for people who renew their rent year after year or maybe had long-term leases, those rents are a little bit slower to adjust. So the CPI was slower to pick up initially after market rents shot up and is now slower to come down. Market rents have come down a bit. They've been declining for 15 months, according to our data. But in total, the drop from the peak is only about 2%. And some of that is regional differences. So some markets have cooled off faster. Other markets, such as in the Northeast and the Midwest, remain pretty hot. And so nationwide, we're down just about 2% from the peak rent that we saw in 2022.
Danielle, aside from potential dynamics within the housing markets itself in terms of supply demand, clearly the banking market, the lending market plays a major role in this sector. And so we've also been talking, obviously, about a lot of potential policy changes with deregulation, lower interest rates going forward. How do you factor in a potential loosening of lending standards related to all these other dynamics and how that could impact housing?
Well, I think we do expect to see more housing starts, particularly on the single family side. We know if we look over the last decade, we've seen a deficit of home building relative to the number of households that are on the market. So there's great need for more construction of residential buildings in the United States. We think, we've just issued our 2025 housing forecast. We think that we are going to see a pickup in single family construction. I think on the multifamily side, it's a little bit more of a question mark. We've got still a very high number of multifamily homes in the construction pipeline, already under construction. We expect a lot of those to hit the market in 2025. And so that is going to help continue some of the market rental relief that we've seen. So we expect rents to decline by about 0.1% as we move into 2025. So we'll see that relief continue. But we're probably also likely to continue to see some catch up from renters who haven't moved because market rents are still quite elevated. They have not come down much from that peak. So I think we're going to see some relief for renters, but not a whole lot. And I do think there's more opportunity for building here in the U.S.
And how about, just to follow on, how about just in terms of those looking to own, just access to mortgage credit and mortgage availability? Is that a trend or a dynamic that you think may loosen in the coming 6 to 12 months?
Yeah, I think mortgage availability has been okay. I think the bigger challenge for the housing market is really on availability and then the affordability of homes. So one of the things that we expect to see in 2025 is that in markets where we see a lot of government financing options, things like VA loans, FHA loans, even USDA loans, we expect those markets to do really well because those products tend to have more favorable financing criteria for buyers. And as a result, I think we're going to see those markets thrive in 2025. So areas with a lot of military or retired military, for example, where residents are more likely to be able to take advantage of VA loan benefits and where the market is more accustomed with sellers having more familiarity with those loan type products and more willing to accept them from a buyer. So I think those are areas that are really poised to shine. For example, in Colorado Springs, that's our top market for 2025. That's where we expect to see the most home sales and price growth in 2025.
Danielle, you brought up policies, which brings me to the point that do you think we could see fresh impetus from this incoming Trump administration and maybe this Republican Congress to do more on housing, either affordability, building new homes, any sort of these provisions in policy? Because this was, leading into the election, one of the main drivers of Americans' concerns. You continuously saw it in polls that prices of housing and rent were just too high.
Yeah, that's absolutely right. Polls reported on it. Both campaigns actually talked quite a bit about housing affordability and had plans to tackle it. So the Trump campaign talked about opening up federal lands to create more land for building. They also talked about making sure that we could cut through regulation to make it easier for builders to do the job. We do know analysis from the home builders estimates that more than $90,000 of the cost of a new home is due to regulation and compliance with that regulation. So there are likely areas of opportunity for some of that red tape to be cut through. And so I do think Trump will tackle that. I think the other benefits to the potential housing market of a Trump administration and Republican Congress could come in the form of growth focus, potentially on tax reform. If people are able to bring home more of their after-tax income, that certainly helps make the share of the budget that they're putting towards housing costs a little bit smaller, and that could be a big benefit. It's not something that we've priced in to our current forecast. It is sort of a risk or positive risk, an upside to the baseline, if you will, but that's something that we're watching to see as well.
Danielle Hale of Realtor.com, thank you so much. And Anne-Marie is checking out the Colorado Springs listings, in particular the luxury, in addition to her 3-star Michelin dinner.
I'm looking at Colorado Springs, and this says the Sun Belt dominated the top 10 housing markets of 2025, according to Realtor.com. Thank you, Danielle, for that. Texas, Florida, and Virginia also in that list. So the Sun Belt and Colorado Springs.
Basically, people want to go where they can play. That seems to be the theme. Yep. Let's get you an update right now on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Israel has stepped up its attacks on military sites in Syria, striking hundreds of targets across the country. According to multiple reports, the strikes targeted army bases, airports, and surface-to-air missile systems. The Israeli attacks have drawn criticism from Arab countries, including Egypt and Saudi Arabia, which accuse Israel of seeking to occupy more Syrian territory and sabotage the country's security and stability. Meanwhile, sales for chipmaker TSMC rose 34% in November thanks to sustained AI demand. The Taiwanese company, which is the go-to chipmaker for Apple and Nvidia, reported monthly sales of $8.5 billion. TSMC is seen as the bellwether for the build-out of AI data centers. Hardware suppliers like it have seen a boost thanks in part by the launch of ChatGPT in late 2022. The stock is up over 90% year to date. Meanwhile, Chinese tech company Xiaomi unveiled its new all-electric SUV, which is expected to go on sale next summer. The YU7 will compete with Tesla's Model Y and BYD in the world's largest market for autos. The announcement signals Xiaomi's efforts to expand its presence into EVs and away from the competitive smartphone market. Analysts are estimating the car will cost between $35,000 and $45,000. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, a 2025 rotation.
The backdrop, I think, from a cyclical perspective is positive for stocks. What we're looking for is broader returns and a focus on diversification to improve risk-adjusted returns.
That's coming up next. This is Bloomberg Surveillance. The quiet ahead of the CPI storm. Right now, we're looking at just mild gains after yesterday's drawback. Interestingly enough, we're seeing small caps outperform yet again, up significantly more than the S&P, which is up now about 0.1%. Under surveillance this morning, a 2025 rotation.
The backdrop, I think, from a cyclical perspective is positive for stocks. So we have high valuations, a lot of good news is priced in. I think the setup is positive, but at the index level, we don't expect to see huge rises. What we're looking for is broader returns and a focus on diversification to improve risk-adjusted returns. So that's really what we're looking to do.
Here's the latest. Small caps outperforming post-election, but Bank of America Securities looking for mid-cap outperformance in 2025. Jill Carey Hall writing, we favor mid over small caps for 2025. We're cautious on small relative to large for now, given small caps have the most post-election policy risk. Refinancing risk has emerged, and small caps have been stuck in an earnings per share recession. Jill, I am very pleased to say, joins us now. Jill, welcome. Thank you so much for being here. I want to start with NFIB small business optimism, which came out this morning at the highest level going back about 3 years at a time that everyone's convinced that the policy mix is going to be auspicious. Why do you push back?
Well, I think, maybe near term, we do see some further upside given small business optimism, consumer confidence, momentum, good seasonality. Usually December is a good time for small caps. But when you look ahead to 2025, I think even though there is a lot of optimism on deregulation and business-friendly policies, I do think that will certainly help some pockets of U.S. small and mid caps. And, financials is a sector we're bullish on. I think there's a lot to be in there from deregulation and in terms of costs. But I think for small caps overall, you look at the backdrop, and if we do see some of the policies that could be more negative to profits in terms of tariffs and immigration policies, small caps are the most labor-intensive size segment. They would also be hurt the most by tariffs. That's at a time when, we've seen better economic data. We've seen, with the red sweep multiple rate cuts priced out of the market, refinancing risk has come back, and small caps are still stuck in this earnings recession they haven't been able to get out of.
A real question here about how much the optimism around small caps is tied to some of the policies that are expected from the Trump administration, and how much is the Fed is going to be cutting rates, even with a growing economy, at a time where there's a real inward focus on the United States and U.S. exceptionalism that would benefit some of these companies disproportionately.
Well, look, I think that's going to be a reason why this year is going to be about picking stocks and picking your spots within the market rather than just buying indices. So I think from an index perspective, mid caps do look the best positioned. I mean, they've historically actually outperformed in the year following when the Fed first started cutting rates, and they have, less post-election policy risk around tariffs and immigration reform. They're the least labor-intensive size segment. Their profits trends have been a bit better in terms of revisions. Next 12 months EPS trends have actually started trending up a little bit for mid caps. They're still coming down in small. So I think that's where I would focus. But from a stock perspective, I think if you can focus on areas of small caps that are more economically sensitive but don't have as much refinancing risk, screening on leverage and those factors, focusing on stocks that have positive rather than negative revisions, since that's the scarce resource right now. There's still opportunities in small caps. The valuation dispersion is high. There's a lot of both cheap and expensive stocks. So, still areas for active stock selection. At BofA, our analysts cover about 1,000 small and mid cap stocks. So there's a lot of opportunity out there.
Joe, I feel like the refinancing risk is a reflection of a long-term structural trend from the last 10 years where private markets have picked off so many quality small assets. So what you're left with in the public markets in small are these more levered, lower quality names. I think looking forward over the next big structural trend over this coming decade, obviously AI is going to impact big companies, but it also feels like small caps or small business models could get disintermediated. So it feels like there's some left tail risk there that I don't think a lot of people talk about. Is that something that your team is thinking about?
Yeah, I think that's the bear case we hear on small caps, the demise of small caps, that small caps have just morphed into these low quality zombie companies. There's no good companies left. I think there are obviously some aspects to that are true. I think we're past peak low quality is the good news, because when we had the IPO boom in 2020, 2021, all these non-profitable companies joined the index. Some of the rebalances in the Russell have taken some of that out. Some companies have started to return to profitability. So we're past maybe peak low quality, but I do think that when you look at metrics like leverage has increased over time, when you look at the quality of the index, the proportion of non-earners, the long-term growth rate of small caps, there aren't as many high growth stocks as there used to be. And then companies are staying private longer, IPOing at bigger market caps. So there has been a shift in the index, and that's one reason why we think the equity risk premium for small caps, even though it's now gone below average, may not go back to the averages that we saw in the 80s and 90s. So, I do still think that there are positive longer term themes for domestic SMID caps, like if we see a CapEx cycle, if we see reshoring continue in the US, that should definitely benefit pockets of the size segment. And just given that it is so historically cheap versus large caps, that should argue that you could potentially see better price returns over the next decade. But near term, we'd still be cautious given the profits environment.
Jill Carey Hall, really fascinating. Thank you so much.
Thank
Jill
you.
Carey Hall of Bank of America Securities. And Dan, that was actually a really interesting point when you look at the idea that private markets have picked off so many of these companies. So even though you're looking at something that structurally could be lower price, it might stay that way for a bit longer because there's sort of been a derating. Is that something that you guys are experiencing?
We've thought about that a lot. I think something like 80% of businesses in the U.S. with over 100 million in revenue are private today. It's just an unbelievable fact. And then secondly, we also think about who will participate from the right tail perspective in AI. And it's definitely more of the Fortune 100, the Fortune 500 than many of these small businesses who don't have the cash flow to invest in it.
Dan Skelly, thank you so much for being with us
My
for a
pleasure.
full hour. Dan Skelly of Morgan Stanley. Coming up, Emily Roland of John Hancock, Port of Los Angeles Executive Director Gene Seroka, Jason Draho of UBS. UBS, and Gennadiy Goldberg of TD Securities as we chart toward tomorrow's CPI amid markets that are trying to inflect higher after yesterday's losses. This is Bloomberg Surveillance.
Animal spirits are back in the U.S. The outlook is, for the near term at least, is pretty bright. There's a sense of optimism that we haven't seen in a while.
The setup is positive, but at the index level, we don't expect to see huge rises. What we're looking for is broader returns.
Returns have really been driven by a narrow collection of stocks. And in our view, narrow stock leadership is fragile stock leadership.
You have some animal spirits and you have the uncertainty removal and you already have strong growth.
I think you can see equities continue to run in that environment.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. This is Bloomberg Surveillance as we claw toward that CPI print tomorrow. Real question here about whether we can continue to gain that momentum still below record highs. 90 minutes to the opening bell. All eyes on tomorrow. Jonathan Ferro is off this week, and joining Anne-Marie and myself, we are so pleased to say, is Nela Richardson of ADP and a Bloomberg Television contributor. A real question here. And Anne-Marie, you know, right now you can feel this feeling in the yield space coming up just a little bit that maybe people are underestimating the risk of inflation.
Well, and you brought it up this morning, Lisa, the New York Fed saying consumers are expecting higher inflation and a better economy. Andrew Hollenhorst, though, comes out with a note. Not overheating. Contrary to the market narrative, economic activity inflation looks set to slow, not to accelerate. So we're back to square one when it comes to this debate of whether or not is it the labor market or is it inflation that is going to be so important for the Fed.
I think it's cute that you make a distinction, actually. I think that they're so tied together, the labor market and inflation. Wages are that bridge that's tying them together. So very smart to make the distinction, but also I think they're quite connected.
At a certain point, we're looking at yesterday pulling back 0.61% on the overall S&P 500. It seems like there's some people are wondering whether this was connected to the geopolitical risk and Syria having a complete pivot point in terms of its leadership. Other people saying actually it's stemming from the yield space and the fact that suddenly you do get better than expected data. Sentiment is inflecting upward. How much do you get this sense, Nela, that really is the driving force at a time when people just look at overseas turmoil as reinforcing American exceptionalism?
Well, American exceptionalism is based on fundamentals. So let's not get that wrong. We have a super strong jobs market. It's solid. We can quibble with some weakness, but consumers are also still spending, supported by that strong labor market. We have a central bank. Again, you may not like the moves next month, but they are on point when it comes to tracking inflation, tracking labor market. So there's a lot of fundamentals feeding into that exceptionalism. What's going on globally in terms of geopolitical is just adding to, I think, the gratefulness of that exceptionalism at a time when so much of the world is in chaos.
World is in chaos. It's a fractured Middle East. There's going to be a vacuum in Syria. And then just last week, we were talking about the core of Europe in political paralysis. First was Germany, then was France. Where else really is there to go?
Yeah, at a certain time, we have to see some sort of policy response in Europe. And we do get an ECB, a rate decision on Thursday, a big call for potentially a 50 basis point rate cut at a time of economic weakness. Coming up this hour, we've got Emily Roland of John Hancock as the equity rally stalls ahead of CPI. Port of Los Angeles Executive Director Gene Seroka as shipping giants brace for the impact of Trump tariffs. And Jason Draho of UBS on why the fear of froth is overdone. We begin this hour with stocks slightly higher. The S&P 500 and NASDAQ still below record highs as investors await one of the Fed's last data points before the decision next week, CPI. Emily Roland of John Hancock saying a December cut is far from a lock. In the 2016 post-election period, the Fed hiked on the thought of more pro-business policy. We don't think they go as far as a hike, but it is getting harder to justify a cut. Emily joins us now. Emily, great to see you. Thanks for being with us. I want to start with whether the real bar is for the Fed to either cut or pause next week, or whether the real issue is how the long end of the yield curve will respond to the much expected Fed rate cut next week.
Yeah, so Lisa, bond market, of course, is expecting a cut. There's about an 86% chance of that happening per Fed funds futures markets. And we would see a pause as as more interpreted like actually the Fed hiking. Again, we don't see that happening, but bond market is expecting that. We actually think if we get the hawkish cut the hawkish cut that's expected next week, I think you could actually see a re-inversion of the yield curve as the 2-year Treasury yield likely reprices significantly higher for that. The 10-year Treasury yield may move up a bit, but we think it sort of chops around here as disinflationary trends continue. We'll see what happens, of course, with CPI tomorrow, but should be interesting going into next week. We may have just given inflation a bit of a shot in the arm with the potential for more pro-cyclical policies, potential for tax cuts, potential. I know we have to keep hedging this. But it's not exactly what we would want going into year end to see inflation surprise on the upside and cause a wrench in the narrative as it relates to the Fed.
And Emily, I know that you've been bullish on bonds. You've been bullish on fixed income. You've been cautious on risk. Have you rethought that in the face of potentially what you just said, which is we could be seeing inflation get a shot in the arm?
Yeah, I think it's all about figuring out where the best relative opportunities are. Even if bond yields chop around here, we still have elevated income that's available. You can get close to a 5% yield on a high quality core or core plus bond portfolio. We still like that. We do want to embrace equities at this stage. The problem is that a lot is in the price. Matt Miskin and I just penned our outlook for 2025, and our key tagline is just resist turning up the volume in portfolios. You look back on the last 2 years, we just had the best 2-year stretch for the S&P 500 since the late 1990s. And all of that came on multiple expansion. In fact, earnings per share for the S&P 500 are now below the high in 2022. That could certainly continue. We don't see elevated valuations as necessarily a catalyst for a shift in leadership, but we want to recognize this. The high that we've seen in recent history was about 24 times earnings, so there's still about 9% to go there. We could see more multiple expansion, but a lot of things have to go right. So we want to look at areas in portfolios to protect against that valuation risk. You had Jill on earlier talking about mid-cap stocks. That's still the sweet spot for us. So certainly there's opportunities. The challenge is the markets are already priced for the soft landing scenario.
Emily, given your view that inflation could be that sleeping dragon that wakes up in 2025, what happens then to multiple expansion if the Fed can't cut quite as much as the markets expect? If the neutral rate is much higher than we think that it's going to be right now, do you still have that projection of more growth in stocks and equities over 2025?
Yeah, I certainly think higher inflation, higher rates could challenge the multiple expansion story. And our base case is you don't see much more of it. Now, the denominator in the PE ratio could certainly be the driver of returns, but the challenge there is that markets are already expecting 15% earnings growth. That's what analysts are penciling in right now. So, of course, that's a very high bar. We certainly think that there's companies that can meet that bar. There's areas of the market like high quality stocks that have great balance sheets, a better ability to protect margins, better ability to see organic growth. And we think we should expect to see a rotation there. It's really about this intersection between quality and value that we think can power markets higher into 2025. But I think it's overly optimistic to think that we're going to get a lot more multiple expansion. There's a lot of positive sentiment pervading markets right now. A lot of investors are really on one side of the boat right now in terms of that optimistic view. You have to sort of rethink it when, a duct tape banana is selling for $6 million. That's a lot of excessive optimism to us.
Yes, certainly. Emily, though, you talk about the fact that everyone's on one side of the boat. But yesterday, there was a brief moment in time where we saw a pullback, and that came after China talked about and announced this probe into NVIDIA. And your favorite sector is U.S. large caps and technology. Are you concerned about that sector next year? We see a tit-for-tat potential trade war between the technology companies of Washington and Beijing.
Yeah, there's certainly some idiosyncratic risk there, Anne-Marie, as far as NVIDIA goes and potentially some other areas of the sector. But it all comes back down to earnings growth for us. And we're big believers that over time, stock prices are going to follow profits. And what we're seeing right now is the best earnings growth estimate by far in U.S. large cap tech companies and large caps in general. In fact, when you look at down into the small cap space, earnings growth has been negative. This past quarter it was negative 7%, and analysts are penciling in a similarly negative earnings growth backdrop into next year. So it's really all about finding where there's better relative growth opportunities are. They're in the United States. Nela talked about this earlier, the fact that the fundamental story in the United States is superior to the rest of the world as far as earnings and the economic growth backdrop goes. So that continues to lead us to mega cap tech stocks. Of course, we have a valuation issue there. So we want to be mindful of that. Again, protecting that with mid-cap industrial stocks, but really looking at those earnings drivers as being the key story into next year and resist turning up the volume.
So, Emily, is there any risk that as the global growth story looks to be somewhat underwhelming, that would challenge these large tech companies who do make a significant portion of their revenues abroad? Could that come back and bite their profits in the U.S.?
Yeah, that's a great question. It's another reason that we're watching things like the dollar. If you do see this hawkish cut or potentially the Fed holding into next year as they did in the 1990s soft landing scenario, that could cause some pretty significant appreciation in the U.S. dollar, which would limit the profits that are being generated from large cap companies abroad. So the geo-rev function is one that we've been looking at closely to see which companies are most exposed to foreign revenues. We're also seeing a bifurcation in global economic growth, again, with the U.S. holding up the best versus countries around the globe. So it's another reason, I think, to embrace mid-cap stocks here without going all the way down into large caps where we're seeing less profitability and lower quality metrics overall. So mid-cap's really the sweet spot there.
A very strong U.S. dollar, though. Couldn't that definitely hurt this U.S. manufacturing renaissance in terms of if those goods have to be exported?
Yeah, it could be a challenge. It's also something that's quite disinflationary, which I think, a lot of investors are really focused on the potential inflationary impacts, particularly around tariffs, tighter immigration policy. We have to remember that a stronger dollar is also disinflationary, which speaks to our outlook that, bond yields should ultimately come down over the course of 2025. So I think those disinflationary forces, things like lower wage growth, things like housing inventory rising, things like commodity prices coming down, all of those speak to the opportunity that's available in terms of income on high quality bonds.
Emily, what would you have to see to change your view that disinflation really was taking hold?
Yeah, I think you're starting to see little signs of it. Looking in the NFIB Small Business Optimism survey, I think that was showing that there's some sort of animal spirits coming alive again. There's a lot of hope around things like tax cuts and things like deregulation that I think is sparking that. But I think what you need to see is wage growth going back up. You need to see, the housing market start to see price appreciation. We're not expecting that. And then the other piece of it that's really critical is if you expect this sort of double resurgence in inflation, that has to come along with higher commodity prices. If you want to see, or if you're expecting this sort of like 1970 style boom in inflation, you've got to see oil prices moving higher, commodity prices broadly. We're just not seeing that right now. Now, of course, you wake up in the morning and there's a meeting in China about maybe doing stimulus there. And that can change the narrative as far as commodity prices go. But broadly, we see slowing demand in China. We see more supply coming online in the commodity space. And we just don't expect to see that surge absent any major geopolitical disruption.
Emily, Roland of John Hancock, thank you so much for being with us. And we'll keep an eye on oil. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Brazilian President Lula da Silva is in intensive care in a hospital in Sao Paulo after undergoing emergency brain surgery. That's according to an official statement from the hospital. Dr. Roberto Calil sharing the president will remain in the ICU for 48 hours as a precaution and will not be working for the next few days. The Brazilian president is expected to resume normal life after observation. Meanwhile, the International Air Transport Association says the global airline industry will see a record 5.2 billion passengers next year. The lobby group's annual forecast calls for the industry to earn over $36 billion in net income. They say lower oil prices and higher demand will drive profitability, but tariffs and trade wars could hurt the industry. And in sports, the Bengals beat the Cowboys on Monday Night Football after a go-ahead touchdown from league-leading receiver Jamar Chase. With the game tied with 2 minutes left, the Cowboys managed to block a punt deep in Bengals territory but failed to secure the ball, allowing Cincinnati to retain possession and set up the winning drive. The loss drops Dallas's record to 5-8 and dims their chances of making the playoffs. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. And we'll phone in to Jonathan Ferro next hour, where we'll be hearing all about that game, which he was at evidently last night. Up next, the morning calls, plus Port of Los Angeles Executive Director Gene Seroka on the outlook for shipping and trade under President-elect Trump. That was fake news. I don't think he was there. We are not going to be calling in. This is Bloomberg Surveillance. Trying to claw out after yesterday's losses, stocks inflecting upward just a touch ahead of tomorrow's CPI. You could see the outperformance in small caps, the S&P up about 0.1% plus or minus. Meanwhile, you do see yields continuing their chart upward. Time now for the morning calls. First up, Piper Sandler raising its price target on Meta to $670, calling it an artificial intelligence leader. Next up, Bernstein upgrading American Airlines to outperform, highlighting its exclusive co-branded credit card deal with Citi. They are all credit card companies, evidently. And finally, Morgan Stanley raising its price target on Tesla to $400, reiterating the company as its top pick in the sector on its autonomous driving goals. Turning to trade, officials from Mexico, Canada, and China warning President-elect Donald Trump's proposed tariffs would harm the economies of all involved. Gene Seroka, executive director of the Port of Los Angeles, which is the largest in the United States, weighing in, writing, in Los Angeles, the implications of new tariffs are significant. For every 4 containers we move, that's another job. 1 in 9 workers in Southern California, about 1 million people, have jobs tied to this port complex. Gene joins us now. Gene, I want to start with, and thank you so much for being here. I want to start with how much you're seeing already some sort of influence of businesses rearranging their supply chains ahead of any potential changes to policy.
Oh, good to be here, Lisa, and happy holidays. A lot. So whether it's retailers, footwear importers, manufacturers bringing in parts and components, folks are front-loading or building up inventories. And that's on top of a relatively strong economy that continues by all of us purchasing, and the other headwinds we face geopolitically. Ongoing negotiations with dock workers back here on the East and Gulf Coast, drought conditions in the Panama that have almost solved themselves, and then the Houthi rebels and security concerns in the Red Sea, all pushing cargo more towards the West Coast. In addition to the hand-wringing about what tariffs could look like, and I've got to build up my inventories to average my costs down.
You named a lot of issues going on there. What is the driving force that companies really want to front load some of these imports?
Cost. Number one.
But because of tariffs, but because of concern about a potential port strike on the East Coast, concerns about the Red Sea? Which one is it?
All of those weigh in together, but it's the topic du jour now. It's the unknown. We kind of understand a little bit about this East Coast negotiation. Tentative agreement set to expire on January 15th. Sporadic talks at the table between employers and the union representatives. As I mentioned, Panama Canal drought seems to be getting back to a little bit normal. We've got crossings of container ships fully loaded, a little bit better than before. No end in sight on the security issues in the Red Sea. But this run up on tariffs, because people don't know exactly how it's going to land. There is a long way from the campaign trail to public policy, but we're not being dismissive of anything. If there is 10% on all $3 trillion worth of American imports, that raises a very different question.
How are executives you're speaking to that import a ton thinking about it? Do they think it's going to be blanket, or do they think it's going to be more narrow, targeted tariffs?
A lot of discussion around, can this be negotiated? Is there a deal out there to be had? Will it be targeted as opposed to blanket? Now, we've all heard 60% tariffs on China goods, 10% broadly. Mexico is in the crosshairs, as well as Canada. Mexico took over China as the #1 importing country for the past 20 years. So there's a lot at stake here. And folks are just trying to try to read what's going to happen, but also prepare their inventory levels in the event it goes down a critical path.
Jean, I have several questions for you about the labor market implications of dock workers and the adjacent employment that gets goods to stores. But before I ask that, the pandemic taught us a lot about the fragility or the potential for fragility in the global supply chain. Where are we now, 4 years later? Is it a stronger, more resilient system, or are we still vulnerable to those kinds of pandemic, climate change, geo-conflicts that really shut down goods transfer 4 years ago?
Nela, I think we learned a lot from the pandemic. In fact, we moved more cargo this year between July and October than we did during the pandemic, and not one ship was backed up. So we took some of the critical areas of velocity of cargo, having the right people with the proper skills on the job at the right time, and making sure that we could read upstream a lot better than we had before. We now have the ability to see cargo 40 days before it gets to Los Angeles, so we can better plan the labor, the component of equipment, as well as the land use that we have. But making sure that we can train people up for the next generation of work is key too. That's why the ports of Long Beach and Los Angeles are building the nation's first goods movement training campus. So everything from young people that want to enter this industry to people my vintage that need to be upskilled or reskilled for tomorrow's technology, that's where our focus lies today.
That is so important. I'm so glad you brought it up, the right people for the right skills, especially when it comes to the global supply chain and what we know could happen to inflation if this system doesn't work. Where are you seeing shortages in the worker movement that keeps goods flowing?
Yeah, we're doing pretty well overall, but it's what's next that we look at. We saw that during the pandemic, there were claims not to have enough truckers on the job. Yet in California, there were over 680,000 commercial driver's license listed. But those truckers didn't want to just sit in line all day waiting for cargo. They went to other sectors to do their business. We want to attract, recruit, and retain quality employees for tomorrow. And that's part of this training play that we're doing, as well as the ongoing efficiency work, because the more turns a trucker can get, the more money they can earn.
How difficult is it to modernize some of the port systems at a time where you've seen strikes? You've seen real concerns about job security with automation coming to a lot of these ports. How much can you really do? And do you feel tied because of some of that employee pushback?
Yeah, it's really tough. And it can't be a zero-sum game. It's the most polarizing conversation we have in our industry, Lisa. We've seen examples of where automation or robotics in a port setting don't cut the workforce to the degree that we've witnessed in Los Angeles. And the fact that in Southern California, the results of automation have been mixed doesn't give confidence to the worker for tomorrow. So we've got to find a way to the middle on this, because expanding land is not an option in LA, as an example, but expanding capacity through new technology is, so long as we don't leave the worker behind.
Before we let you go, how much are you seeing imports from China falling? How much are you seeing that sort of as a small subfraction of what's been coming in, particularly in the past couple of months?
We've talked about this some time now when I've come and visited. By the end of 2022, 57% of our business was with China at the Port of Los Angeles. Today, it's 43% and dropping. Yet we've continued to grow because we've been nimble enough to move to the Southeast Asia market. Nonstop services have been put in by the liner companies, and speed to market, which has always been our hallmark, maintains because of those nonstop services. But the battle is still there.
Jean Seroka, wonderful to have you on. Thank you so much for being here. Jean Seroka, who is the executive director of the Port of Los Angeles. And it's a really interesting time. Nela, and you pointed to this question around automation, how you upgrade talent when there's sort of this existential fear that any kind of change in technology will eliminate jobs.
What was great about this conversation is it's the conflation of a lot of different things. It's the global economy, it's the worker, and it's tech all in one. You're seeing it right there in LA at the port.
Yeah, which is the reason why people are watching it. Coming up next, Jason Draho of UBS and Gennadiy Goldberg of TD Securities. With just 1 day to go before that key CPI print, the last major data read ahead of next week's Federal Reserve meeting. From New York, this is Bloomberg Surveillance. Good morning. Welcome back. We are seeing futures basically going nowhere, up a little bit as people look to some sort of direction ahead of tomorrow's CPI. Right now, you're seeing that outperformance in the NASDAQ. Russell 2000 turned lower 1 hour away from the cash open. Here is your morning movers with Menace Credit.
Lisa, a very good morning to you. How do you find your place in the AI world? You spend, it's the capex. That's the number that we look at. Within Oracle, they're spending $4 billion. The market had estimated it was going to be $3.5 billion. Where do they fit in this space against Amazon, along with Microsoft? They would say they are faster, they are cheaper than any other cloud provider. Right now, the market is more focused on the inline revenue number, $14.1 billion. That's a little bit disappointing, but that capex number is certainly higher than the market had anticipated. Still, you've had a few people come through with upgrades. Piper Sandler, $210, up from 185. Citi, say, 194 from 157. Keep an eye on the capex numbers. Staying with tech, it's all about the overlay. Yes, you're a data analytics company, but what is your overlay? What is your secret sauce in terms of integrating the customer's data to Microsoft's cloud? That's essentially what C3 AI do. The revenue is pretty impressive, up 29%. At $94.3 million, but they're rolling out 15 generative AI trials. So this is about working with the Navy, working with Rolls-Royce, making it easier to take their data from the cloud, from Microsoft Cloud, and integrate it and make it efficient and useful. And that is what Piper Sandler say is underpriced in this stock at the moment. Let me leave you with a snapshot of Google. Yeah, there's a quirk with Google that they're being asked for information by the European regulators, but this morning we're up 4%. They're delivering a new quantum chip to the market, Willow. 300 people within Alphabet are working on quantum computing. It is all about the error correction. It's called the endgame, I'm told confidently. And that is what they're making progress towards. So there's multiple facets with Alphabet and Google this morning, but it is about this cohort of 300 people working on the quantum computing solution for all. Lisa.
Thank you so much, Menace. The end game and quantum computing just leads one to a lot of interesting imaginations. Thank you for that, Menace. Right now, stocks in a holding pattern as traders await the next key U.S. data point, CPI, coming out tomorrow. Jason Draho of UBS writing, there's not much to slow the S&P 500 rally in the near term. Whether new data or expected political developments, the markets seem to be impervious to risks, or at least indifferent to them. Jason joins us now. Jason, good morning and welcome.
Good morning.
Honestly, this to me has been one of the main question marks around this rally. Does the fact that everyone is on one side of the boat lead it to be more vulnerable to tipping over?
Well, sometimes the consensus is right, and so far it's been right for much of the fall. So I think that's reasonable. I think that it could kind of keep running. The market does seem sort of impervious to other political developments in Europe and in South Korea last week, which you could say, is this in complacency, or is it the market kind of calibrating these things ultimately won't materialize in some way? But otherwise, if you look at that, you look at the jobs data, we get the inflation data tomorrow, there doesn't seem to be any sort of catalyst that the markets are really sort of like, pivoting on in some way. That could change, but right now, unless we get negative news, the path of least resistance to me is the markets go higher.
Well, do you find it interesting that we are seeing such big reactions after earnings in certain stocks that have done very well? We just heard Menace talking about Oracle. We heard him talking about C3 AI, and this question around if they don't come out with some massive outperformance, they're punished pretty significantly. Is that signal or is that noise?
Well, I think it's kind of consistent with something we've seen in the markets this year, in which there's dispersion has actually been quite high. So a lot of sort of alpha opportunities for stock pickers on a more micro level. You're seeing big moves, especially in the tech space. I think because it's tied into the whole AI theme. So anything that's sort of related to that, it could be sort of market moving. But at a market-wide level, I don't really, I don't think that's kind of the biggest story, unless you're like at Nvidia, which is so big that can clearly be a market-moving event. Otherwise, it tends to be much more idiosyncratic.
You mentioned the market just brushing off what's going on, whether it's South Korea, the Middle East, what's going on in Europe right now, paralysis at the core. But doesn't that just mean double down in the United States and fuel more U.S. exceptionalism?
So it's interesting the past 2 or 3 weeks, if you look at the market performance in U.S. overall, you've seen equities go up, but it's been more of kind of the quality trade. The tech stocks have done well. You've seen yields decline. So the 10-year, since November 6th, the close the day after the election, the 10-year's down 27 basis points. Break-evens are more than half of that. That doesn't look like a reflation trade. That to me looks like a disinflationary growth trade. Now, is that the case? Or is it also, given the geopolitical events you said, is it a flight to safety? So people look around the world and say, I just want to own U.S. assets. I want to own treasuries. I want to own equities. I want to own the quality stuff in a world with uncertainty. You can kind of explain some of the performance that way as well.
Does that unwind when the uncertainty in the U.S. becomes more prevalent? And a secondary question to that is, you think the Fed has made a big pronouncement of being data dependent for 2 years. Has the market become overly data dependent, where each data point is really affecting sentiment, and the result is to ignore longer-term situations abroad?
So I think on the first question, when does it change? We've seen this year the narrative of the markets sort of change multiple times, from soft landing in Q1, by April low stagflation, the summer was higher landing, now we're in kind of Goldilocks again. When you see these sort of narratives change, then you can see the rotation go towards small cap cyclicals. It might last 2 or 3 weeks, and then it kind of, say, reverts back. So I think we'll get another rotation when there's some clarity, but it might last a short period of time. And that ties into the second point about the data. I think investors, even though they're confident about like no recession, things are good, they're still not convinced that is inflation going to come down, how much is the Fed going to cut. So all it takes is 2 months of data to sort of switch the narrative from one to the other. That again sort of drives the market. So I kind of say like this year the market's up a lot, but it feels like the market's been kind of climbing the wall of work, because it's never really been convinced that everything is in the all clear.
So where do you get conviction right now? If people are really getting whipped around by data points and you have a lot of policy uncertainty, how do you sort of benchmark where your conviction can lie?
So I'd look at just the U.S. economy and like, what's my conviction on how well the economy is performing? Is it going to change much? You look at GDP tracking estimates for the fourth quarter, it's at over 3% on the Atlanta Fed. The consumer continues to spend. So my confidence in the economy next year growing over 2% is still relatively elevated. I think still inflation is going to come down. The Fed will cut, maybe gradually. Still pretty conducive environment for equities and risk assets overall on a 12-month horizon. But the path to get there could be bumpy as we get these political developments, as we get the new administration, as we see this unfold. We know from the past it's not a smooth line. But if you kind of look through some of that noise, then I think 12 months from now, we are in a higher place. But it may not be an easy ride to get there.
So what role overall does foreign assets play in a typical portfolio? If you're a long-term investor, do you just ignore the rest of the world, stay with a safe bet, and bet on U.S. exceptionalism, both in equities and bonds, or is there a place for foreign stocks?
Well, there's definitely a place for foreign allocations. And so you think about kind of a broad global market indices. U.S. equities are about now 2/3, the highest they've ever been. Historically, you don't get them going above that level. Otherwise, something usually kind of breaks, meaning the performance can't last, the rest of the world sort of picks up. So we think it's always important to have a long-term allocation to foreign markets. Now, tactically, and we can tilt tactically in what we would sort of guide, we'd suggest favoring U.S. equities. I think just the risk-reward trade-off here is just more clearly compelling versus in Europe. Political uncertainty. They're cheaper, yes, they could bounce quickly, same thing with China, but it's just harder to have conviction on the policy versus the U.S. It feels a little clear on a relative basis that the fundamentals alone will be supportive for equity markets to perform well here.
When it comes to asset class allocation, one thing people were saying heading into 2024 was this is the death of 60-40. It turns out 60-40 did really well, and it probably outperformed most other strategies at a certain point, unless you went all in on a couple of stocks, in particular, NVIDIA. I'm just wondering, for next year, how that pairs off, how you see that shaking out at a time where really it's inflation risk that potentially could be the biggest torpedo to some of the bullishness that we see, particularly in equities, but really that would have to be expressed in bonds.
So 60-40 works really well when inflation is relatively contained and investors are not concerned about it. We saw that for 20 years, up until 2022, when, of course, inflation became the big problem. The Fed had to raise rates. Both stocks and bonds sold off. There is maybe some complacency in the market that disinflation will continue. To me, the biggest sort of macro risk next year is that inflation doesn't come down. It reaccelerates. The Fed can't cut as much as anticipated. And that relationship between stocks and bonds, that correlation becomes positive. You're not as diversified. That's hard to predict, which is kind of why we also recommend looking at other asset classes to include, kind of diversify, looking whether it's private markets, real assets, gold as an inflation hedge, because that inflation risk is likely to persist. It can flare up every now and then in ways that are just, it's hard to predict, right? Even the Fed would say, we don't have great models for predicting inflation. Therefore, you need to kind of proactively, make your portfolio robust to those scenarios.
Jason Draho, wonderful to see you. Thank you so much for being here with us this morning. Jason Draho of UBS. And speaking of inflation, tomorrow we do get that key CPI read. Michael McKee, Bloomberg economics and policy correspondent, joining us now ahead of that. Mike, what are you preparing for?
Well, we're preparing for more of the same, basically, Lisa. But the problem is the Fed's got to look ahead into 2025 and figure out what's going on. And as we know, predictions are hard, especially about the future. I forget who said that, but somebody important. And I want to point out this morning that the prediction from small businesses is that things are going to be great. The problem is they always tend to think that things are going to be great at the beginning of a Republican administration, and then their confidence falls dramatically, and growth is higher under Democrats. So today we look at this number, and then we also look at the fact that almost all of those people forecast that they're going to be raising prices in 2025. Where's inflation? What are we going to see tomorrow? You can see the blue at the bottom. That's housing. This is the core CPI in our ECAN function. Housing, and the other light blue is automotive services, which is basically car insurance. Those two things have been keeping inflation up. They're expected to keep inflation up tomorrow, another 0.2 to 0.3% on the month, and we see a little bit of a rise year over year, but the Fed is going to be focused more on what's happening next year, and for that, it's not going to be in this November data.
Mike, thank you so much for that. Michael McKee, our Bloomberg economics correspondent. Nela, just a quick word on what you're expecting for tomorrow, given the fact that really it is that inflation surprise that could potentially put a kink in some of the euphoria.
I think we're going to see a continuation of the pattern that we've seen before, inflation stickiness. That's what the labor market is telling you. That's what the housing market is telling you. There's no trigger that unwinds that stickiness yet. And so as long as inflation is sticky, every rate decision is a coin toss, and that's not a great place for the markets to be.
And that's the reason why I'm watching auctions very closely this week, and just in general. Gennadiy Goldberg of TD Securities looking ahead as well to those auctions, as well as next week's Fed meeting, writing, given the stronger than anticipated economic data and increased uncertainty about the impact of likely tariff and immigration policy, the Fed can begin to signal the possibility of a pause or skip to cuts. We expect another rate cut in December, followed by a pause in the first half of 2025. Gennadiy joins us now. Thank you so much for being with us. I want to start with your understanding of the market action so far, and where you think that markets are underpricing some of the risk of what you expect for next year.
I think there's a bit of an underpricing for a potential extended pause. I mean, we're of the view that starting in the first half of next year, you could see the Fed not explicitly, but implicitly start to signal pauses. Certainly in January, by the time we come into March, they could start to kind of look at the Trump tariff announcements, the immigration announcements, and signal a bit of a hands-off if the economy stays as strong as it has been. And I think we can see a protracted period of rates on hold at these higher levels, which could actually push interest rates a little bit higher in the short term. Okay,
so interest rates on the short end or on the long end? Emily Roland was saying that she could see a real flattening out in the yield curve because she does see this disinflationary trend continuing. Do you agree with that, or do you think that overall it'll cause a reassessment of just the stickiness of inflation?
I think in the short term, there's a risk to a flattening of the curve. So I do think that all rates can rise a little bit. Certainly front-end rates can rise a little bit more. You can see that curve flatten a bit. Now, there's worries about fiscal sustainability, of course, and that's going to keep the long end under a bit of pressure. And that's why I'm watching auctions as well. So, there's lots and lots to keep an eye out for. But at the end of the day, the macro is not terrible. Growth is doing okay. The labor market's doing okay, albeit slightly softening over time. Inflation's a little bit stickier. So you are seeing that kind of divergence here. But the issue is, I do think you want to stay very cautious into next year because we just won't know what the Fed's going to do right up until they do it. And you could wind up with a period of rates on hold for a protracted period.
And you mentioned potentially growing of the fiscal deficit. Is that why you say this is the year, 2025, of living dangerously?
Oh, yeah. This is definitely going to be the year of living dangerously. I can tell you one of the number one questions we get asked from clients is, when is the UK going to have their Liz Truss moment? When do we finally have that kind of the bond vigilantes come out? It could certainly be next year, but what we're seeing on the demand side is actually quite encouraging.
Next year, a U.S. Liz Truss moment?
I think there's worries about that. I'm not in that camp, personally, and we're not in that camp, just to be clear. But I do think that's the risk that a lot of investors are bringing up. We're talking about 7% deficit to GDP running for basically as far as the eye can see here. And that is quite dangerous. There's very strong demand for U.S. fixed income. And I think that was mentioned earlier on the program. U.S. exceptionalism is driving a lot of inflows into the U.S. So we're not seeing investors back away yet. But again, we have to watch those auctions. Everything's a risk here when you're flying this high.
That is the other side of the coin in terms of the large fiscal deficits. There is demand for that debt. What happens, though, to that demand if the labor market cools off more than anticipated? If we do see hiring freezes or pauses in hiring, just like we were seeing pauses in rate cuts, what happens to that demand if there's any kinks in the armor in terms of U.S. growth? What happens to the demand for bonds?
That's an interesting one. And usually demand for bonds will go up because you've got an increase in uncertainty. Everyone flies to the risk-free asset, and that will be the U.S. Treasury market. So, what we're always worried about is less so in times of stress because we know there's going to be demand for bonds as a safe haven. The issue is if times are good. And, times like right now, for example, is there a demand for bonds when everything else is yielding you quite a bit as well, and you really have to compete with a lot of other asset classes.
So what are you doing with all of this? Are you basically leaning into a flattener trend, which is exactly the opposite of what we saw a couple of months ago from a lot of investors?
So I think the outlook for 2025 is almost kind of two halves. The first half, I think there's a risk to a curve flattener and to rates remaining a little bit elevated. As we get into later next year, we do expect some of the Trump policies, like tariffs and immigration, to really start to weigh on growth a little bit. And they will keep the Fed cautious. We expect a resumption of cuts in the second half. So we do think rates will drift lower over the course of next year. You want to find very attractive entry points, 450 to 475 on 10s. I think that's where you want to go long. And you want to stay in a kind of a flatter curve up until the second half of next year, and that's where you enter steepeners.
How close do you think that the Fed can get to its 2% target? And if it doesn't, how does the bond market respond?
Not in a good way, certainly. I do think they'll eventually get to the 2% target. The magical thing about the 2% target, it's a very long-term target, right? So they can overshoot it for a while. They undershot it, for example, in the post-2008 decade. And only now have they actually started to overshoot. They will eventually get to 2%. If it seems that inflation is stubbornly stuck at 2.5% or so, I think the bond market is not going to react well. You'll have more term premium priced into the curve, as you should, especially with these high deficits. So I do think there's a lot of pressures that could keep rates a little bit elevated.
I just want to finish up on the ECB rate decision, which comes on Thursday. If they cut by 50 basis points, as some people are arguing they should, not that they will, but that they should, do you just go headlong into European bonds?
I do think the ECB is going to keep lowering rates. That seems to be kind of the default path. We're not quite in the 50 basis point camp, so a little bit more gradual on that side. But I do think there's a lot of central banks out there, between ECB, Bank of Canada, certainly even the Fed, who are looking to ease rates. They all know that policy is tight. They are looking to get closer to neutral, which is a long-term bullish kind of impact for fixed income. It's a tailwind. So I think gradually, yes, but again, just like with the U.S., you have to pick levels very carefully. A lot of it is already priced in, and you want to wait for backups to actually reload.
Gennadiy Goldberg, thank you so much for being with us. Gennadiy Goldberg of TD Securities here with us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hackett. Yahira.
Hi, Lisa. Authorities in New York filed murder charges against a 26-year-old man accused of shooting United Healthcare CEO Brian Thompson last week here in Manhattan. Luigi Mangione was arrested after being spotted at a McDonald's in Altoona, Pennsylvania, where he was found with a ghost gun, fake IDs, and a 3-page manifesto. Mangione remains jailed in Pennsylvania, but authorities say he will eventually be extradited to New York to face charges in connection with Thompson's death. Meanwhile, a fire in Malibu forcing residents to evacuate. The blaze, dubbed the Franklin Fire, tripled in size in just an hour to over 1,800 acres. That's according to CAL FIRE. SoCal Edison warning tens of thousands of residents living in LA County their service might be shut off if winds intensify further. And Alaska Airlines is planning a global expansion next year. The company is planning to start with flights from Seattle to Asia and could expand to as many as 12 routes over the next 5 years. The airline will also introduce a new premium credit card with global travel perks, including a free ticket on Alaska or a partner airline network. And it will increase premium seats in its fleet to 29%. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, and for the entire morning. As always, up next, setting you up for the day ahead, this is Bloomberg Surveillance. About 38 minutes until the opening bell. Here is the trading diary for the week ahead. Today, OPEC's year-end conference. Tomorrow's the biggie, CPI, as well as Macy's earnings. Thursday, an ECB rate decision, plus PPI and another round of jobless claims. And next Wednesday, the main event heading toward the end of the year, the Fed rate decision. Turning to tech, TSMC sales growing 34% in November thanks to sustained growth from AI demand. Mandeep Singh of Bloomberg Intelligence with a final word here. And Mandeep, what's your sense of why this is not being received with particular positivity, given the fact that they still own the market and are seeing really rapid growth?
I mean, look, you could say that the expectations were higher than the 34% growth number. But overall, to me, the market remains solid when it comes to AI chip demand. And, it's converted into cloud workload revenue, which we saw with Oracle last night, 52% growth. All the hyperscalers have raised their CapEx. So, there isn't really anything to find faults here in terms of, the AI story. That remains intact. I mean, you could have a 1% here and there when it comes to growth rates, but a $100 billion plus revenue run rate company in TSMC growing at 34%, it's very impressive. And I think it's mostly tied to AI at this point in terms of their growth rates.
Mandeep, I'd love to get your thoughts on NVIDIA and the fact that China opened this probe yesterday into the company. Do you see more tit for tat in the tech industry?
Absolutely. I think everyone is expecting tariffs to be front and center when the incoming administration comes in, and every administration is going to use their own way of negotiation. So in this case, I think China is clearly seeing that aspect, and NVIDIA being one of the biggest sellers of chips in their market, I think this could be one way to negotiate, as could be Apple. I mean, Apple has a big dependency in China, so it'll be interesting to see how they navigate. But clearly, this will be part of, how the tariff situation and all the geopolitical aspects are dealt with next year.
Mandeep Singh of Bloomberg Intelligence, thank you so much, as always, for your insights. And just to wrap up the hour, Nela Richardson, who has been kind enough to give us this much time, I want to get your take on where you see the bigger risk ahead of CPI, given the fact that people are talking about the potential for a reemergence of inflation, but also slowing growth next year. Which is it to you?
The pandemic upended this relationship between the labor market and inflation. I think going into 2025, it's both. It's higher inflation, slower growth. That's always been the risk, stagflation. Now, there's some ways to avoid that if we see strong hiring, resilient consumer spending, and if the Fed can outmaneuver all these other inflationary forces on the horizon, then we'll have a good 2025. If not, those two twin risks are going to plague the year.
Or if Trump 2.0 can outmaneuver in terms of growth. Bloomberg Economics says they do see higher inflation going into next year, but also higher growth because of the fiscal impulse of some of these policy discussions that are taking place.
Which is the reason why people are getting bulled up now. Question is, if you get both, that sounds a lot like the really dreaded stagflation, which is very difficult for the Fed to really counter with. Nela Richardson of ADP, thank you so much for taking the time with us today.
It's been a pleasure.
Coming up tomorrow, we've got Stuart Kaiser of Citigroup, Monica Guerra of Morgan Stanley, Dana Telsey of Telsey Advisory Group, and David Kelly of JP Morgan, as we do get that key inflation read ahead of next week's Federal Reserve meeting. Thank you for choosing Bloomberg. This was Bloomberg Surveillance.